My name is David Kotok, and before we start what we hope to be a very worthwhile day, and you see the program and you see a list of speakers and presentations, and at the end of today, I hope everybody leaves here and says, geez, I got one little nugget that I didn't have before I walked in. Everyone who came in was offered a mask. And I'm delighted to see everyone in the room took one and put it on. That happens in the United States at every meeting, at every conference. Those of us in the last 2 weeks who flew on an airplane, please raise your hand. Thank you. Those of you who didn't fly on an airplane, please raise your hand. Those who raised their hands and didn't fly on an airplane, look within 3 meters of where you're seated and ask yourself, I'm seated next to someone who flew on an airplane in the last 2 weeks. Everybody here is an adult. The masks are there. I have found that I wear them on airplanes and at meetings at the ETF conference last week with Matt Hogan. The two of us did a panel on the stage with 2,000 people with masks on. And nearly everybody in that conference flew there on an airplane from everywhere in the world. And they didn't have on masks. And they came up afterwards and said, I should do that. And I said, well, that's up to you. So masks are available. They're there for a reason. You may take them home, souvenirs. And we are very hopeful that what has now become 60 to 70,000 confirmed coronavirus cases worldwide, and deaths are now measured in the thousands. And the latest evidence, I spent an hour and a half on this last night, in preparation for today, but the latest evidence is that there are hundreds of thousands of people who are infected with the coronavirus, and they are all over the world, and we will see a ratcheting up of news. And our expectation is that as long as we walk around here in the United States and there's only 14 Americans who have been confirmed cases and we haven't had a cluster or an outbreak anywhere, we'll go on to go to conferences without masks. But if you go through airports, you're going to see more and more people wearing them, and you're going to see more and more people at conferences wearing them. And we can only be hopeful that this is a race that medical science wins. So, with that sobering, glorious opening, welcome to this 4th annual Financial Literacy Day. We're going to open with recognition of 2 people, as we have every year, when we have someone in our midst who has devoted a part of their life to public service. They should be recognized. It's a distinguished recognition. So I'm going to recognize 2 people, and if I'm missing someone, it's only because I don't have it in my notes. The first person, Harry Anon, served as mayor. How many terms, Harry? 3 terms. 3 terms. Stand up. He was mayor of his town in New York before he came to Sarasota. And we're delighted to have him join us. I was his guest just a few days ago at a breakfast of the CEO Forum in Sarasota. So we reciprocated. No one there had a mask either. And the second guest you've met before, she was a speaker last year, and she is Susan Harper. And she, if you recall, if you were here last year, she presented a spellbinding reflection and revelation on the relationship between Canada and Florida. The Consul General of Canada for Florida and elsewhere, Susan Harper, please. So I'm going to ask Karen Holbrook to say a word or two, and then we'll have Eddie Sanchez tell us about the Bloomberg terminal.
Now, I'm feeling really guilty standing here without a mask, but sorry, David. This is a wonderful turnout. Thank you all for being here. This is the fourth of these events, and I have to say I've been to all four of them, David, and every one of them has been spectacular, and it's so good to see this audience here. How many of you, and Susan, welcome back. I hadn't seen you here before, so David was right. You did a fabulous job last year, and we all took wonderful notes. So it's terrific that you're here. How many of you have not been to this campus before? Quite a few of you. So I'm going to be very brief, but tell you a little bit about who we are. We are one of the branch campuses of the University of South Florida, which is a large, preeminent research university that's located primarily in Tampa and has two branches, one here and one in St. Petersburg. And we are a non-residential campus that serves mostly our local population of students in the area. And our goal here is to build a workforce for our community. So our programs, we try to be highly relevant to the kinds of things that are going on, and there's nothing more important than our College of Business. And our dean is here, Tom Becker, is with us today, and a number of our faculty from business. And we try to put programs together that make a great difference. We had a FinTech conference, 2 weeks ago now, again, and hopefully our students would come to that, but a number of the community members came. Today, we will have a lot of our students meeting with Dr. Mester, which is really very exciting this afternoon. So thank you for being here. I'll say just a tiny bit more about our campus. We are consolidating. This seems to be the mode these days. You may have seen, if some of you are from Maryland or from Maine, you may have seen that 6 of the 7 Maine universities are consolidating. Knowing how hard it is to bring the 3 of us together, I can only imagine the impossibility of bringing 6 of 7 universities together under one accreditation. We've been working on this now about a year and a half, and it has to be done by March 15th to get all of us together, and trying to pull 3 campuses that were once together and then diverged rather substantially into 3 very different paths. Trying to bring them back together under one umbrella is not an easy chore, but I can only imagine what it must be like to bring 6 of them together. And of course, this seems to be the legislative season for doing this kind of thing, as the legislature in Florida now is trying to bring together 2 universities that were actually 2 universities that were once part of the University of South Florida. They're taking one of them, New College, which was once us, trying to merge it with Florida State, taking Florida Polytechnic, which was once part of the University of South Florida, and merging it with the University of Florida. So that's on the docket this year. It's in the House right now, and who knows where it will go in the Senate. So very interesting, and it seems to be merger season, so we'll see what happens next year. It might be even more interesting. But as our campus, we have just had the very good fortune of receiving the donation of land for this campus. Our campus actually went halfway back from the road, from Tamiami Trail, halfway back toward the water. But with the donation of land from the Manatee County Commission, we now go all the way to the water. So with that, our goal is to have a new residence hall, have a new student union, and to build a science and technology complex, an integrated science and technology complex. It isn't just science and technology, because it has to have business in it, it has to have humanities, and it has to have the arts, because you cannot have individual disciplines in silos any longer, but you have to bring them together so that they make sense. So that's our goal for the future. When we get there, it's a long-range goal, but it's a good goal and a good plan for this campus, because not only do we want to serve our community, and we'll continue to do that, but we want to bring students in from around the world and from around the country who will stay here. This is an amazing place to live and to work. So I'll probably stop and not talk anymore, because you've got a very important meeting ahead of you, and introduce Eddie Sanchez, who is our director of our Bloomberg Lab. And I have to say, I have to give David credit. We would not have the Bloomberg Lab if it weren't for David Kotok and Cumberland Advisors. We have 12. Maybe you're going to say all that stuff. I will say. He's going to say all that stuff, but I'm just going to say thank you to David, because this really distinguishes us. It's extremely important, and the fact that we recruited Eddie a year ago is equally important. So I'm going to turn it over to him and wish you all a most enjoyable half day, little more than a half day. Thank you for being here.
Good morning, everyone. I just want to wish everybody a happy Valentine's Day. My wife's having surgery this morning, but I wanted to come at least present and to tell you the good things that we're doing here at USF, Sarasota-Manatee with Bloomberg. So I told my wife, at least I have to go do that, and then I'll come visit you. But I felt so bad because when I left this morning, I get a text message saying, Happy Valentine's Day. And I go, oh my God, I forgot today is Valentine's Day. So now I'm kind of in the penalty box, right? I'm not there with my wife's surgery, and I'm giving a presentation, and then I forget Valentine's Day. So I'm off to a good start. Anyways, my name is Eddie Sanchez. Just quick background. I worked on Wall Street for a long time at hedge funds. Okay, and thank God that I decided to get out of the business, because the stock market only goes one way, right? So I don't have to worry about shorting stocks and losing money. Okay, so I did that, and then I decided I didn't have enough stress, so I went to do my doctoral work at University of Florida. Okay, and I was fortunate to have the opportunity to come teach here at the University of South Florida, Sarasota-Manatee. I teach financial markets institutions. I teach a principle of investments class, and I teach an advanced investments class. And I have wonderful students. The beauty of it that I get to basically use Bloomberg each and every time I present in my class, and I can show students, and I can take the work that's in these books, in these textbooks, and show them how these markets work in real time. So let me kind of tell you a little bit about Bloomberg. I think many of you who are in the financial industry know what Bloomberg is. Bloomberg provides 24-hour financial information. And I still keep up with the markets. I don't sleep much. So at 4 o'clock, 5 o'clock in the morning, I'm checking futures to see where the market or what's going on in the rest of the world and what futures are doing. And most of the time, futures are up because we go up every day. So I know exactly, maybe I shouldn't check it anymore because I know what the market's actually doing. So anyways, but we can get price data, trading news, analyst coverage, general news. We can even get weather and sports. And the beauty of Bloomberg, I think it provides you with all this information at your fingertips, right? And having it in the classroom to be able to work with students and show them how we can quickly get information about, we might want to get the Fed minutes. How do we get the Fed minutes? And we can read what Powell is talking about and what he's saying about the economy. So these are the things that Bloomberg allows us to do. And we can get financial information on companies. We can look at stocks. We can look at bonds. We can look at prices. Last night I was giving a class where we were talking about options and how do options get priced. I can actually bring up that information and show students how we price an option, okay, what prices, how do you buy, and how do you sell an option. So these are some of the things that we're doing with Bloomberg in the classroom. We are one of 800 universities that has 12 terminals. And we're a small university. And it's great to have that many terminals. And thanks to David, thanks to Karen, and thanks to Tom, they've come together to support me to be able to do what? To have this package in the Bloomberg Lab. Bloomberg is not cheap. It's very, very expensive to have a Bloomberg terminal, just one terminal. All right, we have 12. And it's beneficial because I have anywhere between 18 and 20 students in the classroom, and we can all log in, we can get on Bloomberg, and we can start the process of going through whatever it is that I'm covering in that day in the classroom. Bloomberg has BMC, which is Bloomberg Market Concepts, which I'll talk about, and it's a certification process. We've certified over 300 students, and I'll talk about that. But let me just quickly give you a little background on what BMC is. It's a comprehensive introduction to the financial markets. Now, our students will cover a lot of these topics, whether it's economic indicators, currencies, fixed income, and equities, but they're able to go through a 10-hour online kind of e-learning and cover these topics. And also, they're tested on it after each module. So this gives them a little bit more knowledge other than learning it from some of the finance professors, such as myself, or Dr. Rick Borghese, or Dr. Chang, in the different classes that they're taking. So, and the courses, again, are delivered in 4 modules: economic indicators, currencies, fixed income, and equities. And I'll go through this quickly. I don't have a lot of time, so I'll give you kind of the high level. So right now, I have about 45 students in total. And most of my students have already been certified using Bloomberg Market Concepts, which is great, okay? And the way I explain it to my students is this. Having this on your resume is just one tool in your toolbox. So when you go and you get a job, you can say, I've done Bloomberg Market Concepts. This past semester, I was working with a student who actually took his CFA. And usually you don't get students in undergraduates taking their CFA exam, and he passed his CFA exam. Less than 50% of the students taking CFA 1 passed that exam. So I was very proud of him. He went through the program here, and he was one of my students. And he was always on Bloomberg, working and trying to educate himself and work to prepare for the CFA exam. So I'm very proud of that. Currently, right now, I have 3 groups in my classroom. Last night, I teach the advanced investment class, and we spend close to 2.5 hours going through Bloomberg. So these 3 groups are looking at 3 different companies. One, they're looking at Microsoft, Google, and Facebook. And we're actually doing kind of a bottoms-up, what I call doing what an analyst on Wall Street would do. Having spent many years doing this type of work, we kind of roll up our sleeves and we start to gather information. We start to get the company financials. We find out what the company does. We start to download the data into spreadsheets so we can do modeling, and we can do dividend discount models. We can do weighted average cost of capital. These are some of the things that our students are doing now. And at the end of the semester, they'll have the opportunity to present to me what they've learned about a company. And this, they'll be able to take into the working world when they work, saying, listen, I've done this bottoms-up analysis. I've used Bloomberg to do it. And I'm not saying Bloomberg is the end-all, be-all for anything. I'm saying it's one tool in the toolbox that they use. So one thing that Bloomberg also has is they have intelligence tools, financial analysis, earnings trends. Bloomberg has everything. So the beauty of it, in a 2-hour time span, I can hit on all these subjects. I can move from the company's financial statements into a spreadsheet, into looking at news. We can also see what the Fed's doing, right? How is the Fed affecting, the economy? The good thing about it is my advanced students will have great questions for Loretta tonight, this afternoon, I'm sorry, and hopefully you'll have some good answers for them, so that'll be fun for them to do. I want to say something about my students, right? Most of these students work. They work. I got 2 students. One student said, Dr. Professor, I was able to get my boss to give me an hour off of my lunchtime break to come and listen to Loretta. Another student sent me a message this morning saying, I was able to work with my boss to change my work shift so I can come and listen to Loretta. And I said, great. I said, these are opportunities that you don't get all the time, and it's awesome that we're able to have a Fed president come and speak to us. So that's wonderful for us, wonderful for the students, and wonderful for the school. Some of the things that we're trying to do with Bloomberg, and it's a kind of a slow process because Bloomberg's a little cumbersome, is to, kind of push Bloomberg out into other disciplines, whether it's accounting, management, marketing, work with students to do research. And I've had a student work for me to do some research. And again, Bloomberg is a great tool to do that. I did my dissertation on municipal bonds, and working with my professor, I had the knowledge of being able to gather data on defaulted municipal bonds. And it was awesome because Bloomberg had all that data, okay? And I had the expertise of using Bloomberg to be able to gather that data when I did my dissertation. So again, the power of Bloomberg is very, very, very strong, and it's been immensely helpful, not only for me, but hopefully for my students now and into the future. Finally, just to cap this off, we're going to continue, right, to provide our students with the tools necessary to have, so when they leave here, not only are they BMC certified, right, but they also have the other tools necessary to become what? Good financial analysts, either on Wall Street, either at the local firms. I think Cumberland has hired some University of South Florida students, so that's a good thing. But my goal is, again, to prepare the students to be able to do those kinds of jobs. One more thing I would say is I'm kind of a rare bird, right? I've done the practitioner work on Wall Street, and now I'm in the classroom providing students with what's in the textbook and how do I bridge those two together. And Bloomberg allows me to do that, right? It allows me to do that real time because I can pull up a slide and I can show you the options pricings, but what does that mean? It's very static. Where in a morning class, when the market's actually, in transaction mode is what I call it, we can see how options change and how the economy or the news will have an effect on the stock price, will have an effect on an options price, okay? So, and then finally, we're going to build a, future network of USF alumni on Bloomberg. And that's a good thing because if I'm looking for a job, I can try to find out who's graduated from either this campus or the University of South Florida campus, and maybe I can send them a message on Bloomberg saying, hey, I'm a student either looking for a job or an internship, and I'm here, I'm taking Dr. Sanchez's class, or Dr. Chang's class, or Dr. Rick Borghesi's class, and I'm trying to get an internship. So hopefully we can build that. Again, we try to do things in baby steps. And as I look at it is developing a process, putting a process in place, right? And then executing, using that process so that hopefully I develop some good students and they go out into the working world. And again, like I said, Noah McFarlane was a student who did his CFA, was a great student, now he's working at a local firm here. So I'm pretty proud of that. So anyway, with that, if anyone has any questions, I think that kind of concludes my, Oh, okay. I will not be here to do a demo. I'm sure people would probably want to listen to me do a demo, maybe not, maybe. But Dr. Chang will be here at 12:30. And those of you who would like to see the Bloomberg Lab, we've done a little upgrade to the Bloomberg Lab, thanks to Karen and thanks to Tom. We've got a beautiful lab. We've got a ticker up. We've got some monitors. We got some televisions, and we also have Bloomberg. So it's a beautiful lab. I'm glad to have it. The students enjoy it, and I think they benefit from it. So Dr. Chang will be here at 12:30. If you want to get together, he's going to do a presentation on the Bloomberg lab, on the Bloomberg terminal and in the lab, and he'll tell you how they use it in corporate finance.
A question, does Michael Bloomberg approve of this presentation?
He probably doesn't, but we've written a lot of checks. You can see why he's a billionaire, so yes. Oh, sign up. There is a sign-up sheet for the Bloomberg Lab, so we can't have 1 million people show up. We probably can only have somewhere between 15 and 20 show up if you want to go see the Bloomberg Lab. So, yes.
Yeah. Can you tell me, if you know, what are the universities in Florida offer the Bloomberg Lab?
I think I have some of them. I know University of Florida has 6 terminals. We have 12. I think Florida International has 12 terminals. University of, I think, Florida, the northern part, University of North Florida has, I think, some Bloomberg terminals too.
How about FSU?
FSU, I think they do have terminals, yes.
Thank you.
I just wanted to reply to that real quickly, too, Eddie.
Yeah.
Tampa has no terminals, and St. Pete has one, but they're trying to change that over the next
Right.
year.
Yes, one more question.
So just a quick, can the student participate in the Bloomberg Lab if they've never had a basic course in accounting?
Absolutely, absolutely. So the nice thing about it is you can get signed up to, and BMC is a great tool because it'll teach you how to use Bloomberg first, right? And then you can actually go through the different modules. So yes, absolutely you can.
Eddie, thank you.
Thank you, David. Appreciate it.
When Cumberland moved to Sarasota 11 years ago and began to hire and expand staff and hired the first USF undergraduate who had completed courses in the business school here and came into our office, and we liked that person and we hired them. And we said, here's a Bloomberg terminal. And she said, what's a Bloomberg terminal? That's where it began. Today, we're 45 people in Sarasota and a couple that are elsewhere. And we manage a few $1 billion of other people's money around the United States from Sarasota, not New Jersey. Nothing against New Jersey. We still have a little office there. And 5 USF graduates work at Cumberland Advisors every day. And every one of them has a full skill set and uses a Bloomberg terminal every day. And in our office, we have 5 Bloomberg terminals. And when we launched this approach with the university, took about a year to negotiate a structure. This is now the 4th Financial Literacy Day. And if you notice, this day is about information and learning, and it's sponsored by us, and we partner with the Global Interdependence Center. You will hear about that in about 1 minute. And what we have done is, and where's Eddie? Eddie, how many total students have been certified in the last 5 years since we've been in business?
Oh, it'll be over 300 students.
Okay, over 300 students completed the course, and you now incorporate the certification in the courses in the school. So, what else do we know? We think that the average entry level compensation for a student who completes this and incorporates it in their business education, this is an undergraduate in their 20s, takes a job in financial services or somewhere else, and the entry level wages are $5,000 or $10,000 a year higher than the peers who don't have that knowledge and education. So if you ever had payback of a multiplier in philanthropy, it's in that Bloomberg Terminal Lab, many times over. Where it goes from here, we don't know, but the second thing I would add, where's Greg Smogard? Here. Okay. This year, on April 23rd, we started last year, and this is, again, we are the university, not we. The university will invite every financial firm from Tampa to Naples. We'll offer a jobs fair with those students who have a certification. So, number one, for a student to get in the room, they need a certification. Am I right, Greg?
And we're also thinking about
Tell everybody what you're doing.
recent graduate, who I am, in terms of, I'm Assistant Vice President, Innovation and Business Development. So I reach out to the business community as well and look at different ways that we can partner with the business community, and had the pleasure of working with David and his team now since I've been here about a year and a half. So regarding the career fair, yes, we're going to reach out. We did it last year, prototyping with David. This year we're going to try to expand it. So again, anybody who's interested in meeting not only alumni who have been graduated with the certification, but we're also talking about, Eddie, right, that's about 2 or 3 weeks before graduation, so we'll have even several people who are about ready to graduate with the certification, so we should have a very nice subset of students that you would like to spend some time with. So we'd welcome anybody who's interested, and we'll be sending out a lot of publicity regarding when and where and what you can expect. So
Anybody interested can see Greg during the day.
absolutely.
Yeah. This is the second year. The first year was pioneering, but the offer to a potential employer is every student in the room needed to complete a certification to get into the room. And then interviews will take place from there. There have been some jobs after the first one, I think 2, if I remember correctly. So that's the process that's underway. Now, who's the Global Interdependence Center? Since they are a partner in everything we have done with the University of South Florida from the very beginning. And you'll hear from the chair and the former chair during the program. So what I'm going to do is ask the executive director, Jill Fernito, to say a word and introduce a video. Jill, please welcome everybody.
Thank you, David. Thank you, Dr. Holbrook, for having us back again this year. It's a pleasure to be here. So you will hear my voice on this upcoming video, which I will tell you the Philadelphia accent has been completely scrubbed out. So, but GIC, we're a nonprofit organization. We're actually headquartered inside the Philadelphia Federal Reserve Bank, and we were established in 1976, and we have programs in the U.S. and around the world on issues that affect the global economy. We have a couple upcoming programs in the next few months. Next week we'll be in Mexico City for a delegation-style program, and then we'll be back here in Sarasota, March 20th, for a program on energy policy, and then we'll be heading to Paris with Banque de France for a central banking series program, and then in July we have our 12th annual Rocky Mountain Economic Summit, which is a wonderful event in the Jackson Hole area. So I invite you to join us. We are a membership organization. You are welcome to join us as members as well. And so you can see information about that on our website, which is interdependence.org. And so I guess we can roll the video and let me know what you think. Welcome to the Global Interdependence Center's 4th Annual Financial Literacy Day, Understanding Global Markets and Finance, presented in partnership with the University of South Florida, Sarasota-Manatee, and Cumberland Advisors. I want to tell you about who we are, how we got here, where we've been, and how your participation today contributes to our goal of an open and professional dialogue on the important issues of political economy that matter to all of us. The Global Interdependence Center, known as GIC, was founded in 1976 in Philadelphia by Frederick Heldring, Howard Perlmutter, and Nobel Prize winner Lawrence Klein. GIC's mission is to encourage the expansion of global dialogue and free trade in order to improve cooperation and understanding among nations with the goal of reducing international conflicts and improving worldwide living standards. We are a neutral convener of dialogue and debate. We provide a public and professional forum for the exchange of divergent perspectives. We engage experts to identify emerging economic, social, and political issues vital to the global community. GIC organizes country and region-specific meetings, conferences, and briefings for educational and networking opportunities. Since its inception, GIC has hosted 55 international programs throughout 28 countries covering a diverse range of topics such as food and water scarcity and its challenges to international stability, central banking, monetary policy, QE, international trade and emerging markets, financial technology and digital innovation, and the roles of higher education in competitiveness and global productivity. We promote the exchange of knowledge and expertise among governments, non-governmental organizations, corporations, businesses, and academic and research institutions. GIC also prides itself on openly sharing its findings with policymakers and the press worldwide. On December 14, 2018, the Global Interdependence Center announced our College of Central Bankers. GIC enjoys a long and trusted rapport with the current and former leaders of central banks in the U.S. and across the globe. We are excited that this initiative further deepens and sustains GIC's relationships with former leaders of the world's central banks, continuing to bring their unparalleled skills and experience to the dual challenges of global growth and price stability. On a final note, GIC is a 501c3 nonprofit organization. Our conferences are supported by our corporate and individual members. I also want you to know that the extraordinary speakers we have with us today have come at their own or their firm's expense, joining with you to contribute their time, expertise, and voices to expand and deepen the global dialogue. Thank you and enjoy the conference.
The day is going to go like this. We're going to get the first panel. You want to bring up the first panel, Bill? It's okay.
Well, when you're ready to hand it over, I'll take over.
Okay. The moderator of the first panel is Bill Strauss from the Federal Reserve Bank of Chicago. We will have then a second commentary from the former chair, or a former chair, of the Budget Committee of the United States Senate. Then we'll break, come back for the second set of panels, and then we'll hear from Loretta Mester, and you will meet some people along the way, and I'll turn this over to Bill Strauss.
All right. All right, thank you, David, and good morning, everybody, and so glad to be participating in this Financial Literacy Day, something that's very important from the Fed's perspective, and certainly my own personal view is that we absolutely need as much financial literacy. When you look at a lot of statistics that are out there, we do Fed surveys of consumer finance, and you find out that in the most recent survey that 4 out of every 10 households could not come up with $400 to meet an emergency expense without selling an asset or something like that. It tells us that we need to do a better job making sure that people are financially savvy, and certainly this type of program is helpful with that. The first topic that we're going to touch upon is the bond market. And we actually have two speakers. We lost one of our speakers was not able to join us, so Chris is not on the program. But we're going to have it basically with two presentations to start, and they'll come up individually, and then all three of us will then come up onto the podium to do the little more of a discussion and take questions from all of you, which is, I think, an important thing to do. So the two panelists that we do have joining us this morning, one of which is a local favorite. These are both good friends of mine. We have John Musso, who is the CEO and president of Cumberland Advisors, right here in Sarasota. And then we have Jay Bryson, who is the acting chief economist and managing director for Wells Fargo Securities. So two experts who are going to kind of talk about the bond market. And we'll start off with John. We'll go in the order in the program. So.
Thank you, Bill. Also, if no one has these, we have copies of the presentation out on the table outside the room, so you can get one later on. I just wanted to first say something. I got to meet Dr. Sanchez when he was doing his dissertation on municipal bonds, and he came into the shop, and we talked for a while. And when I became CEO a couple of years ago, one of the things that I demanded was that I got to keep running the bond area because that was the fun part of the job. And I have two USF graduates working for me, and I can tell you I would be a dead person without them because they do a lot of the heavy lifting in the day-to-day world of the bond management and do a terrific job. So I cannot say enough about USF graduates. What I wanted to try to do today is run through a little bit about what we have seen in the bond market, touch about municipal bonds as well, and the health of municipalities. And then, Bill, I guess we'll take questions later on afterwards. After Jay's done his presentation, we'll do it in a panel discussion. We are in a world where I have not seen very much in my 30-plus years of managing bond portfolios, where we are at negative real rates. In other words, take away inflation and you don't have any return left. And I went the wrong way. Let's see. Got it. The first graph, if you look at here, this is the 30-year Treasury bond versus core inflation. It takes you back 30 years. And if you go back to 1990, basically most of the time, up till about 2008, until the financial crisis, you actually got a decent yield over inflation. And core inflation, there's many measures of inflation. There's the PCE, there's headline CPI. Core inflation, which throws out food and energy, we've found has been maybe the best indicator of inflation. And here you are with basically, you can see on the right-hand graph where we are now, we're at zero. And the spread between the two is in the bottom graph. And you can see that after touching it briefly in 2016, the bond market's yields rebounded. And then, of course, they declined this past year. And if you look back to 16, I don't know, it seems like it's in the rearview mirror now, but that is when Brexit happened. And everybody thought the world was coming to an end, and you thought that, things were going to be terrible. The 10-year bond hit a low of 135 then. But it didn't take long for yields to start to rebound. If you remember, the stock market was down 700 points, but it rebounded quickly, and people thought, what's going on in Britain's really not going to slow down Google very much. And yields started to rise. And, of course, after President Trump got elected, everyone thought we'd have all this growth, tax cuts, which we did get, but it took a year. thought we'd have all this inflation, which we didn't get, but they took it out of the bond market. And then last year, rates came down basically because not what was going on in this country, which is 3.5% unemployment, low inflation, decent growth, stock market, which was performing terrifically. Yields came down because of yields in Europe and Japan were very low, and we were closing the gap. This is tax-free bonds, very similar pattern. Yield spreads have come down, and municipal bonds for the last few years have traditionally yielded more than Treasury bonds, which is an anomaly because you pay taxes on Treasuries, you don't on a tax-free municipal bond, no federal taxes. And yet those yields have come down terrifically in the past year. Now, part of that is just following Treasuries along. The other part of it, of course, is the fact that demand for municipal bonds went up significantly after the 2017 tax bill. And part of that is the fact that no longer are your state income taxes nor your local property taxes deductible. So, in other words, it's very hard to achieve a tax-free income stream anywhere else. Even in real estate, because remember they cut the amount of mortgage deduction down from a mortgage of $1 million down to $750,000. So the demand for municipal bonds, particularly in high-tax states like New York, New Jersey, California, has just mushroomed. So that has sent those yields down. And those spreads, while not zero, are almost zero. However, when you factor in the tax exemption, it actually looks pretty good. And this is one reason why, even with yields as low as they are, there's still a robust demand for munis out there. And what we did here is we grossed up the nominal number so you see what the taxable equivalent yield is based on whatever the top marginal tax rate was in place at the time. But again, it is the same pattern. It's been a downward shift, and you're at a point where munis are certainly a better buy than Treasuries because of the tax exemption, but the spread has gotten much lower to inflation. One thing that we're concerned about, nobody else seems very concerned about it, but I can tell you that we get a little concerned about it. They sure as hell aren't concerned in Washington about it. And that's the amount of federal debt outstanding. And if you look at the 10 years from the start of the Great Recession to 2018 or 2019, you doubled the amount. And this is all federal debt. So it's not only Treasuries, it's student loans, guarantees, it's Fannie Mae, Freddie Mac, anything that has a federal guarantee on it. And you basically doubled it. And you went from a little under 11 trillion to over 23 trillion. You're going to keep going. But here's the rub. The net debt expense was pretty low. Didn't grow that much during the 10 years. And why? It didn't grow because interest rates were so low during the time period after the Great Recession. Remember, the Fed kept the Fed funds target from 0 to 1/4 from 2008 all the way to December of 2015, which meant if you were the government and you had a 5-year bond you issued in 2011 at 3% or 3.25%, when that rolled over in 2016, you were able to roll it into another 5-year instrument at probably 0.7%. The point being is that the interest expense did not increase that much relative to the amount of debt that was growing out there. But as you go forward, the interest expense on that debt is going to grow, and if you believe the CBO estimates, it's going to be growing at an increasing rate. Now, that isn't as big a problem as it sounds if the economy is growing and that interest expense as a percentage of GDP isn't overtaking everything. That's why everything you hear out of Washington is growth, whether it's a tax cut, whether it's infrastructure, et cetera, it's all based on growth. And we will see, because if you don't grow, this could become a wet blanket on the economy. And, and actually probably keep interest rates lower, believe it or not. Here's the other side. Here's the deficit. You see the deficit, which basically during the financial crisis just mushroomed and took us to $1.4 trillion. Well, in 2012, two things happened. You had Congress finally agreed that they couldn't agree on spending. And so they put sequestration into place and had automatic 7% cuts on non-essential services. So that was the expense side. They started cutting the expenses. And on the tax side, we know that the top marginal rate went from 36% up to 39.6. So between the two, that $1.4 trillion got whittled down to the 0.4. It is going the other way right now. Do we know when it stops? We don't. It's hard for me to believe that a Senate, which still has a lot of conservative Southern Republicans in it, would allow to see that deficit, go back to over the $1.5 trillion range. But we'll see. But it is clearly heading in the wrong direction. A little bit about where we are, and this gives you a flavor, because the one thing that we heard so much about last summer was flat yield curves. And in the middle of the summer, how many people read, flat yield curves, they predict recessions? Well, they were in every newspaper. And the one thing that you know is that they don't predict recessions, they cause recessions. And they cause recessions because when you have a flat yield curve, banks can't make money. You cannot borrow short and lend longer and make enough spread to cover your expenses, et cetera. So the result when you're there is that you start to pull your horns in. However, let's take a quick look. July of 16, the red line, that's when Brexit happened. So rates were very low, particularly in the short end. Because remember, in the middle of 16, you had only had one Fed rate increase in December the year before. Then you got to the election, the green line. And that was basically, a few months after, the green line is December of 16. That was a month after Trump got elected, and you can see that big jump up that we talked about. And those were interest rates rising, thinking we were going to get all the spending. Then you get to a year ago, last November, and that is the green line. And what happened? All during 18 and 17, the Fed was raising interest rates, short-term interest rates. You got to the end of the year. We know the stock market started to sputter. And why did it sputter? Well, it sputtered not so much where the level of interest rates were. I mean, let's look at this. I mean, you had a 3% 10-year bond. You look back at the history of the 10-year bond in the last 30 years, and that's still pretty darn low. No, what was spooking the markets was the Fed's language. And the Fed's language was, hey, we're a little bit on autopilot, and we think the economy's doing well, and we're just going to continue to raise short rates. Not necessarily every meeting, but enough. That scared the heck out of the markets, and they knocked the stock market down. Don't think for a minute that Trump and Jay Powell didn't have a tete-a-tete, at least in my opinion. But it was unbelievable how the change in the Fed's language, which went from more or less on autopilot to, you know what, we're going to be a little data dependent and we're going to be accommodative if necessary. Just that change in tone turned the markets around. Stock markets, we know what it did last year. The S&P was up over 30%. But bond yields suddenly had a reason to go lower, and they did. And look at that drop from the green line down to where that purple line is now. One important fact, though. If you go back to where you are now, and clearly that is a flat yield curve, that is a curve that got its flatness not from the Fed raising rates. They cut rates 3 times last year. That is a flat yield curve that occurred because of long rates coming down. So the fact is you got there by longer term interest rates dropping, not short term interest rates rising, is a very important piece of the puzzle. And it is a reason why we have not had a recession and doesn't look like we're having a recession, and the economy is doing just fine. And as we'll see, some of this drop that we see right now in the last few months, the last few 10 weeks, has been mostly related to the coronavirus. This is the spread between 2-year and 10-year Treasury yields. And last summer, you can see that big drop, it was negative. That's when everyone was saying, oh, woe is us, we have a flat yield curve. Well, it turned around and that front end of the yield curve steepened up, And that drop you see in the last month or so, that is the coronavirus. We fully expect as the coronavirus gets into the rearview mirror, we don't know when that exactly will be, you'll see this resume its steepening. That kind of a steepening yield curve is not the sign of an economy that is going backwards. That is a sign of an economy that's in pretty decent shape. Same thing is true when you look at 2 years versus 30-year bond yields. Again, big drop last summer, resumption of a steeper yield curve, and a little bit give back here with the coronavirus. Yes, sir.
Can you, for the audience, can you explain exactly why you're saying that drop was because of the coronavirus? What's the linkage there?
When you saw the coronavirus first hit the news about a month ago, a little less than a month ago, you knew that, what did it bring? It meant uncertainty. And when you see uncertainty, two things happen. People run to the safety of U.S. Treasury bonds, number one, and they also will start to put some doubts into the stock market. We saw that with the stock market being as jittery as it was during the middle of the coronavirus. And as David pointed out in our shop, the second derivative was important because as the coronavirus was starting to take hold, the number of cases was increasing at an increasing rate. So you know that if you saw 100 cases reported on day one, it meant they actually got it 10 days before, more or less. So that was increasing. As you got into the last couple of weeks, certainly the last week, the number of cases was still increasing, but the rate of increase had been slowing. And that is, I think, what gave the legs to the stock market that you've seen a little bit. And actually, bond yields have resumed going back a little bit higher, not much higher, but we expect to see them a little bit higher. The bond market will bounce around with the coronavirus, just like the stock market, for sure. Let me just go back. This is a long municipal bond yield compared to a long Treasury yield. You can see that this has collapsed. And this has a couple of important meanings to it. The fact is that municipalities right now aren't gaining a lot by issuing bonds in tax-exempt form. In other words, they can issue bonds in taxable form almost for the same level of interest rates. So clearly, in a world like this, the investor would get the benefit of owning a tax-exempt bond because of the nature of the tax exemption. The issuing body, they're not getting much of a break at all. That's one of the reasons you've started to see municipalities use the taxable bond market to issue more and more debt. Last year, you had $420 billion or so issued in municipal bonds. Probably $75 billion of that were taxable munis. And why? Because of this rate differential, and you don't have to go nearly through the amount of legal hoops to issue taxable bonds. Federal government's great to take a piece of the action. The other thing that happened was another part of the 2017 tax bill disallowed municipalities doing what they called advance refundings, which is basically selling more tax-exempt debt, putting that money aside, buying treasuries, and paying off some older, higher coupon bonds they had issued years before at the first call date. So if a municipality, if the Florida Turnpike issued bonds in 2013 in the middle of the taper tantrum at 5%, go ahead a few years and they could issue bonds 3.5%, put the money aside and pay off those bonds at the first call date, which is probably 2023 or 22. That was disallowed by the tax bill. Reason why? Federal government wasn't getting a piece of the action. They looked at the Florida Turnpike, saw $500 million outstanding, another $500 million in refunding bonds that would be outstanding for 5 years, and said, this is $1 billion and we're not getting anything out of it. So they disallowed it. Municipalities figured it out though. They could go issue bonds today, take a 220, 30-year Treasury bond, issue bonds 140 basis points over. That takes you out to about a 360 or so. They'll issue bonds at a 360. And they will advance refund those old 5% bonds. So that's been what's going on. They lose a little bit on the Treasury escrow, but they've saved so much money in the out years on the difference between 5% and 3.5% that more and more municipalities are doing it. As long as this spread stays small, you will see taxable municipal issuance, and we use taxable munis a lot in our shop. You'll see more and more municipalities taking advantage of it. Here's what I think is very important. I put together, along with my crackerjack assistant, Tom Patterson, these charts looking at time periods when core inflation really went above the 10-year Treasury bond. We ran these back 40 years, all the way back to 1970. And you can see that period of time, 74 to 75. That was right around when all the Richard Nixon hearings were going on, and he resigned from office, and inflation was out of control, and you had a war in the Gulf, and oil prices were rising. And you can see it lasted about a year. Then you get out to the 1980s, another oil spike, Iran hostage situations, again, inflation spiking up. And we know that one of the important things that's not listed on this is that in October of 1979, Paul Volcker, who just passed away, became Fed chairman and changed the tone of how the Fed operated, and they would let interest rates rise and really try to quell inflation, and they did. And you can see we spent the next 20 years out to 2000, and the market's saying, well, you'll have to show us inflation coming down before we take rates down. And they did. And you saw that positive spread last a long time. And here's the last 20 years, from 2000 to now. And it wasn't until you got past the financial crisis that you got to these time periods of inflation being above the 10-year bond yield. You had a brief period of time in October of 11. That lasted about a year and a half. Then you had that time period during Brexit in 16. That lasted only about 9 months. And then you see from July 19 to now. The one thing you know, looking back at these three charts of 30 years, 40 years, is that the time periods where inflation remains above the 10-year bond yield is not long. They tend to be around a year. So we're expecting to see two things happen. Either inflation has to roll over and play dead, and it doesn't show any signs of doing that. Core inflation on a run rate just ticked up to 2.5%. 2.5 is not 2. So we'll see whether the bond market starts to get the hint or not. And we don't expect to see this gap around probably by the time you get to the end of the summer. A little bit here. This is the German 10-year bond and the U.S. bond. If you took this graph back 50 years, you'd never see 50 basis points on either side would be the biggest spread. We know that so much of this drop in German 10-year bond yields is related to the fallout that you started with Greece in Europe, et cetera. We believe this gap will narrow over time, probably by European yields rising because they figured out that negative rates were not working, and U.S. yields rising, but probably not quite as much. A little bit about municipalities. They're in much better shape because stock markets have helped the pensions. The good economy has really helped out the coffers of states. They're in much better shape, tax-wise, revenue-wise. However, pensions are another story. And this is an adjusted net pension liability, so after you do the discounting, and that where it says tread water, that basically says, are those states making the minimum amount of contributions to keep things from getting worse? And the answer is no. And the one thing that you can see when you see Illinois, Kentucky, Connecticut, state of New Jersey, we don't think any of those states are going broke at this point. However, we're also not buying any bonds having to do with any of those states. The ones on the bottom are the better states. A little bit here. Here's pension levels. You can see, again, some of the same culprits up top and the better states down below. So clearly some states have it right and other states have just not paid any attention whatsoever. By the way, you look at something like the state of Connecticut, you don't want to own the state of Connecticut's general obligation bonds. Doesn't mean that you don't own other things in Connecticut. You can own the New London Water Authority, you can own Yale University. There's plenty of credits in the state you can own. You just don't want to be tied into the state itself. This is on the city level, same thing. Some of the bigger burdens, and you can see Chicago up there. Bill, I won't have Bill comment on that because Bill likes Florida. And right. and the least burdensome. And surprisingly, you see, D.C., which years ago was a miserably run city, is much better run. We're going to stop there. I'm going to turn it over to Jane. We'll take some questions later on.
Okay, thanks, John. John's already shown some of this as it relates to the federal government, but I'm going to really kind of zero in on that. So I'm going to show you a chart that John had put up. I'm going to give you a little bit longer sort of period here. So here's the total debt outstanding. John, it started at like 1980 or so. This goes back to 1940. And you look at that, you think, oh my God, right? Well, here's the little dirty secret. Anything that grows over time is going to exhibit that sort of behavior, right? You think about it. What's a 10% of 100? It's 10. What's 10% of 1,000? It's 100. What's 10% of 10,000? It's 1,000. So if I were to put, say, Ford Motor Company or GM, their debt, you're going to see the same sort of parabolic thing going on there. So what you have to do is you have to scale stuff. You have to scale it by something else that grows over time. We typically do this with GDP. So let's look at this now at GDP, and I love this next chart. So this is debt as a percent of GDP. I love it because it goes back to 1790. You can see the entire republic here. And that Mount Everest there, about 2/3 of the way through, that's the Second World War. And so what you see here is it's not as nasty as that right there, but it is still going in that direction. And this is obviously the highest we've been, in peacetime. Okay, so this is a stock concept that is total debt outstanding. So how's this change over time? That's called a flow. So what we're going to look at now are the deficits and the surpluses in dollar terms. This goes back to 1970, and you can see, for most of the period, we've run deficits. There was a period, as you probably remember, in the mid to late 1990s, we actually had surpluses. Back then, people were actually talking about retiring the federal debt. What are we going to do when there's no more Treasury securities? How did that work out? Right. And then we had a recession in 2000. Tax revenues kind of collapsed, go into deficits, and then you see the Great Recession. So the deficit today of $1 trillion, we've been higher than that. That was in 2009. We got up to about 1.5 trillion. I'll show you a chart here in just a second why that occurred. And then between 2009 and 2016, 17, the deficit was coming down, and now it's starting, as you can see, kind of go the other way, and now we're up to $1 trillion. All right, so so that's the actual amount of the deficit. Let's put it into, again, let's scale it. I'm going to scale it into GDP sort of terms. And so this is what you see here. This is the deficit or surplus measured as a percent of GDP. What those green lines show you is periods of time when the deficit is getting smaller. And it typically corresponds, if you see those gray bars, those are recessions. Okay, so the deficits tend to get smaller when the economy is expanding because more and more people are going to work, they're paying taxes, tax revenues go up, and the deficit starts to come down. This period of time, which we're in right now, with the red line, this is the first time in at least the last 40-some years where during an expansion, the deficit as a percent of GDP is actually widening at this point, okay? And so why is that? So let's break the deficit into its two different parts. Let's look at the spending side, and let's look at the revenue side. And here's what you see. So the light blue line at the top is spending as a percent of GDP, goes back to 1970. The bottom line there is revenues as a percent of GDP. And so where we are right now on spending, it's about 21% of GDP. By the way, this is pretty much at its long-term average right now. And then what you see there is on spending, revenues as a percent of GDP. And the reason you got that big deficit back in 2009 is the blue line, as you can see, goes up. So 9 million people lost their jobs. They collect unemployment insurance. Okay, we also had a stimulus program back there that pushed that thing up. And that has come down as a percent of GDP. And then when you look at revenues, you saw how that just cratered. Right? When 9 million people lose their jobs, they stop paying federal income taxes. And when corporate profits go to zero, corporate payments go to zero as well. Okay, but what's interesting when you look more recently, you can see the blue line has ticked up a little bit. So part of the budget bill at the end of 2017, they increased federal spending. So that's kind of has gone up there. But the big decline in terms of tax revenues, as you can see over the last few years, that was the tax cuts that had occurred. It's starting to go the other way now a little bit, but still we're down. We're at 16%. The long-term average here is around 18%. So we're actually below the long-term average there. All right, so let's break these things apart. So what about federal spending? Where do we spend our money? So if you look at that blue thing up there on the right, about a quarter of it is in the major health programs, Medicare, Medicaid. Social Security is down there on the bottom right. So together, those entitlements eat up about 50% of the federal budget. Okay, other mandatory things up there on the northwest, that would be federal retirement, and there's a bunch of things that go into that, generally mandatory. Down here on the southwest, we pay about 8% of the budget goes into paying net interest expense. And then defense is there on the green on the left, and then non-defense discretionary is on the bottom left. So here's the thing. Right, there's a lot of talk about how you cut the deficit on the spending side. So Medicare, Medicaid, Social Security are essentially politically untouchable. That's half of it. Defense is, maybe you can make some cuts there, but no one wants to make huge cuts to the defense budget. And then unless you're going to default on the debt, which is probably not a good idea, you got to pay the net interest expense. Essentially what you end up fighting over is that non-defense discretionary. That's only 15% of the budget. And if you really want to attack the deficit from the spending side of things, you've got to go after Medicare, Medicaid, Social Security, and defense. Okay, there was a bank robber back in the 1930s. His name was Willie Sutton. Okay, and finally one day they caught Willie, and they said, "Willie, why do you rob banks?" You know what his answer was? Because that's where the money is. Okay? If you really want to do something about the deficit on the spending side of things, that's where the money is. You can cut the National Endowment for the Arts all the way to zero. That's not going to do anything for the deficit. Now, I'm not saying that's a philosophical question, right? Whether the federal government should be putting money into things like the National Endowment for the Arts and the Humanities and other sorts of things. But it does very little in terms of the deficit. If you really want to attack the deficit from the spending side, there's where it is. In terms of the revenue, where does the federal government get its revenue? Half of it comes from individual income taxes. Okay, and then 36% comes from payroll taxes. So it's largely on us folks, right? Corporate taxes, you can see, is pretty small. It's about 7% of the budget. And then that's a catch-all for a lot of different things. It would be, federal gasoline taxes would be in there. Tariffs would be in there. But, by and large, it's 85% is on the individual side of things. Okay, so this is going forward. What I showed you up to now is where we've been. These are the CBO projections going out for the next 10 years. If you look at the top line, what you see there is, so right now, as you can see, we're roughly at the average over the last 40-some years in terms of spending as a percent of GDP. You can see that's rising, and I'll show you why in just a second. On the bottom one, that's the light blue one, that starts to come up, and then you can see around 2025, it really kind of jumps up. What that is assuming is, so when CBO does these projections, it's all based on current legislation. CBO does not make any assumptions about what Congress will do. Okay, and so part of the budget law right now, or the tax cut law that was passed at the end of 2017, is those personal income tax cuts that you got in 2018, they go away in 2026, unless Congress acts. Okay, and so if Congress does act, then you don't get that bump up. If Congress extends these things, then you're not going to get that bump up. there at the latter part of this decade. Here's the deficit going forward. And so I've got it both in dollar terms and as a percent of GDP. So those bars, again, these are all CBO projections. $1 trillion are here to stay by the CBO projections. And again, you've got to measure this as a percent of GDP. That's what the line does. And so it doesn't look as bad when you measure it as a percent of GDP. The red line there, so we're at around 5% right now, and we're going to stay there and maybe even widen a little bit. Okay? All right, hold on to your hats. So this is the deficits going forward. Oh, not yet. Okay. And then this is why spending goes up. So if you look at the bottom part there, that's Social Security. That's going to continue to go up for the next 20-some years, and then it starts to come back down because we baby boomers are dying off at that point. But if you look at the light blue ones, then what you see there is that's the Medicare and Medicaid. And that's based largely on the part that medical inflation is outstripping the rest of inflation. The orange is other programs, and that kind of gets squeezed over time, and then the light green is the net interest on the debt, and that continues, as you can see, to kind of rise. All right. Here's the CBO projections of debt to GDP. Debt, okay? And, we're at 80% right now, and by 2050, where this runs out, we're up to 140% if under current legislation. All right, so everybody's in the fetal position right now, right? I'm not. Why not? At least not right now. All right, well, let me explain why I'm not, at least not right now. So what I would say is, and I'm going to show you a bunch of slides here. What I would say is we need to, sooner or later, preferably sooner, have an adult conversation about what we're going to do here. But we're not having an adult conversation is the problem. But I don't worry about this becoming another Lehman Brothers in the foreseeable future. Why? Let me show you a few charts here. So now I'm putting the US debt to GDP ratio in perspective. Looking at our major trading partners, we're right in the middle. Okay, we're equal with France, but we're below Italy, and look at Japan. You think 100% is pretty bad? That's 250%. Okay, Germany's kind of the gold standard down there at 50%, but we're right kind of in the middle. Here is who holds the Treasury debt. It's pretty widely held. It's not like it's just held by one person or one sector. So households directly hold about 11%, just through their holdings of Treasury securities, their direct holdings. The Fed holds about 12%. 10 years ago, that was a lot smaller. The quantitative easing, and now a bunch of that's sitting on the Fed's balance sheet. It's over $2 trillion of Treasury securities today. U.S. financial institutions, so this would be banks, this would be mutual funds, et cetera, hold about a little more than a third. And so part of that is then indirectly held by individuals, right? If you bought a Treasury mutual fund from some company, that would show up back on the household balance sheet. And foreigners own about a little bit more than a third. About 10 years ago, it was closer to 50% that was held by foreigners. So the point here, it's pretty widely held by different sorts of people. It's not like one person can dump it all. There's lots, it's widely held. When you look at, if you zero in on this foreign sort of stuff and say, all right, who holds it? By just the foreigners alone, China and Japan are the big guys who hold it. Okay, but you can see Brazil holds over $200 billion. Ireland, the UK, Sweden. So, there's a number of different, it's kind of widely held by all these foreigners. Everyone makes a big deal about the Chinese, how much they hold. It's only about 7% of the total, okay? And then another thing that's going on, and this kind of explains a little bit, to get back to what John was talking about, why rates are so low, why they've been trended so low. Here I'm looking at the advanced economies of the world. And so the dark line is savings as a percent of GDP. So this is about 35, 36 different countries. So this is the savings as a percent of all that GDP. And then the blue line is investment. The point here is there's a savings glut in the world. Okay? There's just not a lot of great investment opportunities out there. There's a savings glut. And so what are people doing? They're buying Treasury securities because they don't have a lot of better alternatives. And this glut is probably going to continue for a while. As long as it does, it's going to keep those long-term rates kind of down where they are. And then kind of the final chart here is now I'm showing you the sizes of different bond markets. So the United States is there on the left-hand side, 23 trillion. The closest guy next to us in terms of size of the bond market would be Japan. Japan is roughly a half the size of us. And what those dots then show you is the yields on the 10-year securities. So right now our yield is, let's call it close to 2%. In Japan, if you own a 10-year Japanese government bond, the yield to maturity is 0. Okay? Everybody else is pretty tiny. People talk about Germany as being, okay, they're going to dump Treasury securities and they're going to move into German government bonds. Okay, problem with that is the German government bond market is 1/10 the size of the Treasury market. And the yield on the 10-year German government bond right now is negative. Okay, other than the fact that it's negative and it's not really a liquid market, other than that, it's a great trade. Don't get me wrong. Okay? So here's the point. Do we need to have an adult conversation about how we're going to address that chart I showed you before? Yes. Is the Treasury market going to collapse anytime soon? No. There are no alternatives to U.S. Treasury securities. Treasury securities are the deepest, most liquid, most transparent financial market in the world. Treasuries are collateral for all sorts of other sorts of financial transactions. Germany is 1/10 the size of ours. You've got negative rates over there. Some of you folks remember a song that Johnny Cash sang back in the 1960s, Sunday Morning Coming Down. One of the lines was, I woke up Sunday morning and I fumbled through my closet to find my cleanest dirty shirt. Treasury securities are the cleanest dirty shirt. Okay? There's another line there I also like is, the beer I had for breakfast wasn't so bad, so I had another for dessert. So we're going to talk about that. But so, in any case, is this an issue? Yes. Are we looking at a financial crisis in the United States next year because of Treasury debt? No. Thank you very much.
Wonderful. Thank you, Jay and John, for a great presentation. Yeah, the reference that John was making with Chicago, Illinois, is one of the reasons why I bought a house here in Lakewood Ranch early November, retiring June 1st, and this will be my new home. I'm looking forward to it. So, Jay, let me start off with you with regard to this relatively sanguine view that you have with regard to U.S. debt. What would actually cause you to have a different view, become more concerned about the level of debt?
Right, that's a good question. So I think there's two things that could make me change my tune. One would be if you were to get an inflation spike here. So if inflation were to really start to raise its ugly head, what happens is, certainly at the long end of the curve, investors then start to build in inflation protection. And so you would see nominal yields start to go up, right? And so then the interest payments start to move higher. Now, what the Treasury could do is it could come down the curve. It doesn't necessarily need to issue out in the 10 and 30-year space. If it wanted to minimize its interest payments, it could come down to the short end of the curve. But then the problem is, then you become more sensitive to Fed rate hikes at that point. And if you were to have higher inflation in the United States, the Fed likely would be at some point starting to hike rates again. And so if the Fed were to get too aggressive, you could go back into recession, and then the deficit could actually really start to explode at that point. So that's one way. Now, what's the probability of a big inflation spike anytime soon? I think it's relatively low. I'm not going to say it's zero, but I think it's relatively low. The second way that I think you could potentially get into a problem, and I would put the probability of this a little bit higher, is if we do something to destabilize the dollar. Okay, and what I mean by that is, so you're a German investor, and you have the opportunity to invest in a 10-year German government bond earning 0 or a 10-year Treasury earning 2%. Why wouldn't you do that trade all day long? Well, the answer is because there's foreign exchange risk there, right? You know, there's a 2% differential between those two bonds over the course of a year. The euro-dollar exchange rate can move 2% in a day, and it can wipe out that entire yield pickup that you have. And so there's no secret that the administration would like to see the dollar weaker to help our exports. And so if they start to talk down the dollar and or actually start to actively intervene to try to push the dollar lower, what you could potentially see is foreigners who own a third of it could actually not show up at the Treasury auctions and or start to dump the debt. And, you know, that would last for a while. It could cause a dislocation in the bond market as that occurs. So I think that's the two ways that I think I would get a little bit more pessimistic about the outlook.
Okay, great. Let me take one more question, and then I'll open it up to the audience, but a question for John. We've got a record expansion, at least in duration. It's been all in all kind of a moderate 2.3% growth since the middle of 2009 for the economy, about 127 months of growth, besting the previous expansion record of 120 months in the 90s. So when we do, the business cycle, in my view, certainly is not dead, and we could have another downturn. We could have some kind of a crisis that could trip us over. Can you tell us a little bit about what interest rates have done in the past when we've gone through these crises?
You know, well, when you do hit a crisis, we know that people run to the safety of U.S. Treasuries. I don't see that changing. Run to other places. I do think that the growth that we've seen, it's continuing because the downshift that you saw in 08, 09 was so severe, the worst since the Great Depression, that as you come out of this run rate, it just lasts longer. The acceleration effect, keeps you on a steady rate. And inflation has been low. Just to jump on what Jay was talking about, that is something that scares us a little bit, is if you saw to have an inflation spike. Because the one thing that has been stable through all of this has been people's expectation that inflation will be where it was last year or probably lower. What happens when that becomes inflation is going to be where it was last year or probably higher? That really changes the mix. It talks about the inflation premium that Jay said, and I don't think you need any better indicator that you'll see some higher inflation by the fact that on the cover of Business Week last year, they had a picture of an animal supposed to be inflation, and it says the death of inflation. And we know that when Business Week pushes that's usually you're at the bottom.
All right, very good. Question at the back of the room, please.
Bob Bunting, the Climate Adaptation Center. I just was struck by John, your chart at the very beginning, one of the first ones you showed, where the interest rates have been coming down since, 1980 or something. Yeah, and continuing to come down. And I thought, as a climate scientist, I thought, wouldn't it be fun to put on the opposite trend as the world debt, not just ours, but the debt in the world has gone up. And one's going down like this and one's going up like this, if you would put them on the same chart. And then I wonder about why are the interest rates really coming down because the sovereign countries, they know they can't pay off the debt, they know they can't pay high interest rates, so the interest rates are being sort of lowered over time so that they can service their increasing debts.
Yeah, I think a lot of it goes to the demand part, and I'll let Jay chime in here too, that you see out there, and the worldwide, glut of savings. You look back on just a few years ago, and financially, at least the economy is in much better shape now than it was as little as 5-6 years ago. And 6 years ago, 10-year government bond was higher than it is now. So I think a lot of it is this glut of savings trying to find a home. And the crazy part about it is that if you saw the spike in inflation, suddenly they might not want to own that debt, but it's going to take a while to get there.
Yeah, so I've got some thoughts on that. So if you look at that chart that John had going back to 1980, so if you look at interest rates, there's two components of that when we think of interest rates, we think of terms in nominal sort of terms. Your mortgage is 3.5% or whatever. So there's two components of that. One would be the inflation component. And so what has happened, and John showed this on his chart, is that inflation has collapsed since the 1980s. And so that inflation compensation part has come down. The other component is the so-called real return, okay? And that's the inflation adjusted return. There's a number of reasons why that has come down, but probably one of the biggest ones when you look around the world, and these are global capital markets, is the long-term growth economic growth potential in many countries is a lot lower today than it was a number of decades ago. Part of it's demographics, right? I mean, if you look at Japan, their economy, population is going down. Germany is starting to decline. Everybody else across Europe is either flat to down. Our growth rate here has slowed. So, our population growth rate. And so that puts downward pressure on terms of the real economy, which then puts downward pressure on the real yield. And then the second thing is in terms of productivity. Productivity growth, for reasons that aren't completely well understood, has been anemic in this cycle. And so those two components, slower population or labor force growth and slower productivity growth, has put the downward pressure on real yields. And when you look at the advanced economies of the world, the demographics aren't going to turn around anytime soon. And unless you have a major technological revolution, productivity growth is probably going to remain somewhat low as well. So I think what that means is we are probably in a low interest rate world for a long period of time.
I would just add one thing to that, though, and you talk about demographics, and one thing that doesn't get a lot of credence is that if you take the millennials that are out there, which is a bigger group than the baby boomers in nominal terms, and did a bell curve of their ages, the front edge of the millennials, the largest bulge, is turning 30 this year, which starts to tell you that not only are you going to start to see a lot more spending by millennials, but it'll probably come at an increasing rate. And the other part of that is that there's a chunk of millennials who got out of college between, say, 2007 and 2010, so there's 4 years, who faced the worst job prospects ever because of the Great Recession. And their careers got delayed 3 or 4 years. They took jobs wherever they could get them. They got turned down by training programs a couple of years later because they said, we're only hiring recent graduates. And so they're finally getting to the point of catching up and spending money too. So I think the spending actually, if anything, surprises on the upside.
Okay, great. Right here in front.
So kind of two questions. A number of those charts about federal debt and whatever, a number of years back, the Social Security and Medicare rates went up and they banked the money. But essentially, it was lending within the government. Essentially, they didn't have to go out and buy treasuries because it's coming in the form of payroll taxes. And the Fed in the last decade has been doing QE type work and building up a huge balance sheet. Are those effects shown on those charts?
Yeah, I mean, in terms of the total debt outstanding is the total debt outstanding, right? The Fed owns, what was it, 20 no, I can't remember the number off the top of my head, but yeah, the Fed owns part of that, but that's already taken into account with those charts there.
Jay, I have a question, actually two questions, one on the negative bonds, but we'll just deal with the stock market first. If you think about what the Fed has done starting sometime in September, you had the QE going on. And then if you start to look at some of the large cap companies like Apple and Microsoft and Google and Amazon that seem to just kind of go up in price every day, for instance, Apple's added $450 billion in market cap in 4 months. Their earnings have not changed all that much in 5 years. So as you start to look at the equity market, and I'll give you another example. When Tesla goes up and then goes down by $100 in 5 minutes, are we starting to see these animalistic spirits in the equity markets start to seep in? And then this next thing is probably seeing the same thing with bonds. We've got all this money coming into the system that needs to go somewhere, and the Fed's trying to basically, They're trying to get inflation up, and all that's happening is asset prices, financial asset prices are just skyrocketing. So I'm trying to get your thoughts on that. And then my next question will be is on, why would you buy a bond that has a negative rate? And the only argument I can make is that you think that rate is going to go even more negative because then the price of that bond will go up. So you have to be thinking that there's going to be deflation at some point in time. Okay?
So to your second question, yes. If you think, so the reason why you would potentially buy a bond with a negative rate is if you think there's going to be deflation. That, I mean, you can take $1 million and you can put it under your mattress and it's not real safe there. You can take $1 million, you can buy a treasury, or you can buy a bond with a negative rate, and if you think prices are going to fall more than that negative rate, then in real terms, it's a positive, and that's why you would do it. So in terms of your first question, in terms of the equity markets and everything, I really feel, I have many flashbacks to 20 years ago. The spring of February of 2020, right? You know, the equity market at an all-time high, the unemployment rate, 2000, what did I say? Yeah, okay, sorry, 2000, right? So back then, equity market at an all-time high, unemployment rate really low, everyone's really, really bullish. What could possibly go wrong? Let me tell you. And so to put your point about the earnings really haven't gone up, if you look at the operating earnings of the S&P 500 in the third quarter, we don't have the fourth quarter in completely yet, but the operating earnings of the S&P 500 in the third quarter on a year-over-year basis are flat. If you look at a broader measure of corporate-wide or economy-wide profits, this comes out of the GDP accounts, same sort of thing, it's essentially flat.
My advice would be to sell Tesla stock and buy a Tesla.
That's a good trade. And so we've done a lot of work in this, looking at the financial health of the business sector, the non-financial corporate sector. And so a long time ago, in a former life, I was a university professor of economics. I know how to give letter grades. And so if I had to give a letter grade to the financial health of the non-financial corporate sector right now, it'd be a C. The C is, it's not awful, but it's not great. And so it's not at a point where I'm worried about corporate debt's going to bring us down. But what I do think about is if you have a shock, coronavirus maybe, and it causes growth to slow here even more, in an effort to protect their bottom lines, do businesses then start to retrench? And as soon as they start to lay people off, that's when you're in a recession. So it's not, the business sector is not as resilient as it was a number of years ago.
And I'll take issue with the fact of Fed policy only having an influence on the equity markets. I think we certainly have seen mortgage rates come down, which has absolutely given some additional boost for the housing market, and auto loans are also being priced a little bit lower. We're seeing auto sales continue at a very solid pace. So it's a broader context of inflation demand. GDP is not coming down.
GDP is going up.
GDP continues to rise. The growth rate is, well, the trend is 1.8 to 2% according to. All right. Last question, because we're going to break at 10:05.
So my question is the core CPI numbers and the 30-year Treasury charts that you shared. So the core CPI does not include food and energy. And can you give a little flavor on, energy is at its lowest, which is also adding to that savings glut because it's, more money in the pocket of consumers. And it's also tied into the dollar, which you talked about earlier. The dollar is holding pretty strong, which is resulting in the, commodities coming down. So can you give a little flavor on if you were to take into account some of the, the energy and where the dollar is at this point?
I'll take the first part of it, which with regard to energy, I mean, we've seen this, amazing energy revolution that has taken place in the United States, where now we are arguably tied with Saudi Arabia in terms of being able to produce oil, tied with Russia, the largest gas producer. And no country has both of those, and we do. So we are just an amazing change that has taken place there. It has reduced our amounts of imports, and exports have soared. And in fact, in December, for the very first time in our lives, we now are a net exporter of crude and petroleum products. So this concept of us being this, need of these resources has really been turned on its head. the shale revolution, though, is still a nascent technology. It's only been around for, really impactful for about a dozen years. And they are learning a lot. So even though we are seeing a reduction in the number of wells that are being drilled, output continues to rise because the wells that are being drilled are more productive than ever. With regard to the energy prices and all that impacting it, gasoline, for example, or the energy spent by consumers is about 4 cents out of every dollar. This is, again, about the lowest share that we've seen in all of our lives. And so it's making it a challenge. You talk about buying a Tesla. I mean, the new technologies can't even break 5% market share with the vehicles that are being sold because of how inexpensive energy prices are. With regard to the aspect of the international, I'm going to leave it to these gentlemen to talk about the dollar and that impact.
You mean in terms of energy and the dollar and all that sort of stuff, or?
Yeah, I mean, you said, one of the risk factors would be that if the dollar devalues.
Yeah, right.
The dollar is strong, so that's why the commodities are low. So
Right.
there is a correlationship, even though, we ignore food and energy in the core CPI, but at the end of the day, the real world, it does matter.
Well, global trade in energy, oil, is 100 million barrels a day or something like that, okay? And so if you gross that up, 50 times 100 million, what is that, $5 billion? One of his trades could be $5 billion, well, maybe not, but, $5 billion is in terms of the capital markets, the international capital markets is pretty small. And so the point here is what really affects the dollar is not so much trade and energy products and stuff like that. That's pretty small. It's the financial transactions that's trillions of dollars a day. It just dwarfs the trade in terms of certainly energy, but in all goods and services as well.
GDP growth plays a much bigger role.
I would just add on that, and just not speaking for the firm personally, I'm a strong dollar guy. And if you went back a few years ago when we actually had a policy that was trying to knock the dollar down and for trade reasons and whatever, we saw what happened to oil spike. We saw the commodity spike. If you went that route again, I wouldn't be surprised to see them spike again.
Before we thank this panel and get to the next session, Senator Conrad, let me just summarize. Ladies and gentlemen, you heard forecasts from economists at this Financial Literacy Day. They forecast the dollar, interest rates, the deficits, implied the stock markets, a few words about Tesla, and the outlook for the oil markets. Now, what you need to know is that at the annual Financial Literacy Day here, all forecasts come with a guarantee. You heard the forecasts. Come back next year, bring their forecasts with you, and we guarantee you will get a new one. Thank the panel. Thank you. I want to bring up Kathleen Stephenson. Kathleen is the chair of the Global Interdependence Center, and she will introduce Senator Conrad.
Thank you, David. Good morning to everybody. And I just want to say a big thank you to Karen and David for this outstanding conference. So, introduction, Senator Kent Conrad. He is a senior fellow of the Bipartisan Policy Center and co-chair of the Commission on Retirement Securities and Personal Savings. But he has had a distinguished career, a long career in the Senate. He was first elected to the Senate as the senator for North Dakota in 1986. And he has served as chairman or ranking member of the Senate Budget Committee for 12 years. He was an early proponent, or still is a proponent, of the National Commission on Fiscal Responsibility and Reform, otherwise known as the Simpson-Bowles agreement or proposal, I should say. He was also part of the campaign to fix the debt. So what you've heard so far, the presentations from both Jay and John, is the perfect setting stone, if you will, or setting the stage, I should say, for the senator to really delve into the question of why is the deficit a danger? Why is debt a danger? So we will hear much more about this situation with the senator. And just, to elaborate a little bit on this notion of the interest on the debt, with the CBO's projections that we've heard so far, I would like to quote Bill Gale from the Brookings Institution, because his reaction to the CBOs and also to the Trump administration's proposal, the budget proposal, he said that the only good thing about the latest fiscal outlook is that interest rates are expected to remain low. So the rest is really much more on a negative. So please join me and welcome Senator Ken Conrad.
Well, good morning. So I am from North Dakota, represented North Dakota in the United States Senate for 26 years. I was first elected, as the introduction indicated, 1986, so served until the end of 2012. And as was indicated, for many years I was chairman of the Senate Budget Committee. That is not a happy position. I can tell you that in the United States Senate. I spent about 5 years trying to convince my colleagues to do something about burgeoning debt and was almost completely unsuccessful. So that's why I'm here in Sarasota. My wife and I are baseball people. My wife, for many years, 18 years, was the chief lobbyist for Major League Baseball. She retired from that last year. Now, she and I are working for the Baltimore Orioles. We advise the Baltimore Orioles. And that's really the reason we came to Sarasota. When the Orioles came to Sarasota from Fort Lauderdale, we came here as well. So, fell in love with Sarasota and became residents 4 years ago. So we are delighted to be here. Now, I'm not sure if I know how to advance this. Maybe somebody can show me how to advance this. I'm going to just very quickly, this one right here. So you've seen some of this before. This looks at it a little differently. This is, again, as percentage of GDP. And you can see this chart you saw by a previous presenter. The yellow dotted line is where we are now, 2020. You can see that debt has been rising quite dramatically, especially since the very deep recession we had 2008. But look beyond the yellow line. I think that should attract all of our attention. That's showing the debt soaring, and these are projections by the Congressional Budget Office as a share of GDP, and getting into territory we've never seen before. I think that should concern all of us. I mean, when we're getting into territory where we've never been before, to me that's a red light. Let me go to the next. This shows the red line is the spending, the blue line are the revenues of the United States. You can see that gap widens after this year. Spending continues to go up, revenue is basically flat, and so deficits broaden, and of course debt increases. What are the drivers? Well, this chart shows that the major healthcare programs are really culprit number one. Social Security comes next because, of course, retirement of the baby boom generation, and that's not a forecast, right? Baby boomers have been born, they're alive today, they're going to retire, they're going to be Social Security eligible, and so we pretty much know what's going to occur. Major healthcare programs, look at that, just up, up, and away. So shame on you, any of you who've gotten sick. We just can't permit that anymore. Coronavirus, my goodness. But this really is the challenge of our time. And I'm going to talk a little about that as we go further. This is another way of looking at what's happening with entitlements. That's Social Security and Medicare. Medicaid, major health care programs are in red, Social Security is in orange. You can see as we go forward how they're crowding out other spending. They're crowding out those discretionary spending that the federal government does. Education programs, parks, law enforcement, all of that is being squeezed. It used to be that discretionary spending was about 2/3 of federal spending. Now, and entitlements, Medicare, Social Security were about 1/3. That's now flipped. And now Medicare, Social Security, the other entitlements are 2/3 of spending. The discretionary accounts are 1/3. And the pressure on those domestic accounts, those discretionary accounts, just continues to get more serious as we go forward. Revenue side. This is a thing that, to me, gets too little attention. A deficit is a result of spending on one side of the equation, revenue on the other side of the equation. If we look at the balanced budget era, 1998, 99, 2000, 2001, you see that revenue was about 19% of GDP. If we're looking forward for 2020 to 2030, revenue is down to 17% of GDP. So when I hear some of my colleagues say the deficit and debt is all on the spending side of the equation, really? I don't think so. I think deficits are a result of the imbalance between spending and revenue. And if your revenue is below historic norms, it would seem to me that would be an indication maybe your revenue is too low. Not only do we have a circumstance in which revenue is low by historical terms, but spending is higher than historical norms. And of course, that's fundamentally the reason of the baby boom generation and the underlying demographics. But I did want to point out the reality of the revenue shortfalls that we anticipate in the next 10 years. So what do we do about all this? Well, I showed you the healthcare accounts are our biggest driver of deficits and debts going forward. I tried to convince my colleagues that we ought to focus like a laser on one statistic. One statistic. That is 5% of Medicare beneficiaries spend 50% of the money. Doesn't that jump out at you? 5% of Medicare beneficiaries use 50% of the resources of Medicare. That is true throughout the healthcare system. Who are the 5%? Well, first of all, that's about 2 million people. They are the chronically ill. They are people who have diabetes. They are people who have multiple chronic conditions. And those people absorb an enormous amount of our Medicare programs and Medicaid programs as well. So how could we save money and not endanger the care that they receive? The argument that I have made to my colleagues is by better coordinating care. We do a great job, in large measure across the country, of providing quality health care. If you had some very serious illness and you're anywhere in the world, where do you want to come? You want to come to America. That's undeniable. It is also undeniable that we are spending twice as much per capita as any other country in the world on healthcare. Twice as much. And our healthcare outcomes for the most developed nations are frankly not quite as good. I mean, if you look at broad measures of healthcare performance, France, Germany, Switzerland, they really getting better healthcare outcomes than we are. So I think you really have to question the fundamental model that we have of healthcare in this country. Coordination of care. One of the things we learned is if you look at the average person who is in this chronically ill condition, they're taking on average 16 prescription drugs. 16 prescription drugs a day. When my father-in-law was in his final illness, we went to his home, got out on the counter, all of the prescription drugs he was taking. Sure enough, he was taking 16. I get on the phone to the doctor, and I say, how can this be? And I go down the list. Third drug, he said, my God, he shouldn't be taking that. He shouldn't have been taking that the last 3 years. I get down, a couple of more drugs down. Oh, my God, he shouldn't be taking those two. They work against each other. I said, Doc, how does this happen? He said, well, it's very simple. He's got a heart doctor, he's got a lung doctor, he's got me as his general practitioner, he's getting prescription drugs mail order, he's getting them at the corner pharmacy, he's getting them at the beach pharmacy. He's sick and confused, his wife is sick and confused. We have chaos. I bet you there's not a person in here who couldn't tell that same kind of story about a family member. Elderly, sick and confused, taking multiple drugs. One of the biggest causes of hospitalization is adverse drug interaction. I think it accounts for something like 20% of hospitalization. So we are not doing a good job of coordinating care. As a result, we've got way too many duplicate tests being done. We've got lots of duplicative care. We've got lots of prescription drugs being taken that should not be taken. And this is driving up the cost of our healthcare system geometrically. So that's something we could do something about. For a number of years, I've been in charge of a commission on retirement security for the Bipartisan Policy Center. And we also focused on Social Security because the trustees of Social Security tell us Social Security is going to be insolvent in 2034. The HI Trust Fund, Medicare Trust Fund, is going to be insolvent in 2026. I was a little taken by the previous presenters how seemingly unconcerned they were about this trajectory of deficit and debt. I don't share that view. Count me out on being not very worried, because they didn't mention Social Security is going to be insolvent in 2034. Frankly, I think it's going to be a little earlier than that. What happens when Social Security is insolvent? It doesn't mean no money goes out. It does mean there will have to be a 23% cut across the board for every Social Security recipient. Think about that. We got half the people in this country, retirees, who are fully dependent on Social Security for their income. And you cut them 23%? They're going to be enormous consequences. Medicare, insolvent in 2026, according to the trustees. There are real consequences that flow from this debt. And here we have a circumstance in which, according to the Federal Reserve, 40% of the American people say they'd have a hard time coming up with $400 for an emergency car repair. Yesterday, one of the major credit card companies just issued an analysis that said 70% of the American people would have a hard time coming up with $500 for an emergency expense. And we're not worried about Social Security running out of money and everybody having to take a 23% cut? I'm worried. I would hope people would be worried. I'd hope people would start to have this adult discussion that they talked about. It's not happening. In fact, to me, Washington is so divorced from any reality. It's all happy talk. It's, don't worry, we just keep running up the debt. We're running up the debt when the economy is strong. We've got reasonable economic growth, not the greatest, but pretty good. We've got low unemployment, very low unemployment, and still we're adding massively to the debt. This is unprecedented in our history. So, Social Security, we had this commission, 19 members, governors, former senators, House members, experts on retirement. We spent 2 years and totally bipartisan, equally divided Republican and Democrat. At the end, 18 of the 19 of us agreed to the recommendations. Here's the imbalance in Social Security alone. You see we're 6.42%, 6.4, 4.6 on the revenue side, 6.4% on the benefits. That's as a share of GDP. That is an enormous, enormous gap between revenue and expenditures in Social Security. That's according to the trustees' report. Our commission recommended closing that gap, and when you then add in the interest that's available, we made Social Security solvent for 75 years and beyond. How do we do it? We did it without injuring lower income people and without injuring the poverty rates of the elderly. In fact, we dramatically reduced the poverty rates of the elderly, reduced the poverty rate by a third. How do we do that? Well, the number one way we did it was to change the way it works when one spouse is lost. The way it works now, if one spouse passes, the other spouse gets the higher of the two Social Security checks. We said, no, instead of doing that, let the spouse who is surviving get 100% of her benefit plus 75% of the deceased spouse's benefit. We also created a new minimum benefit to supplement Social Security for lower earning beneficiaries. That increased for the bottom 20%, increased what they're currently getting by 66% relative to what's payable, 34% relative to what's scheduled. We increased the taxable maximum to $195,000 a year. When we did this, the taxable maximum was, I think, $126,000. We raised the payroll tax rate by 0.1%, evenly split between employees and employers each year for 10 years. We adopted superlative CPI, or some people call it chain CPI, for annual cost of living adjustments, so slightly reduced the amount of the annual cost of living adjustment. And we gradually raised the full retirement age by 1 month every 2 years, starting for individuals who had reached 62 in 2022. So very modest increase, and people are living longer. People are living a lot longer. We got to adjust things if we're going to make this all add up. The earliest age of eligibility remained unchanged at 62. I also handed out for you, because I think I'm probably over time, I handed out to you a chart that shows where you could go to look for additional savings. I've indicated Social Security, laid out a program that shows you we could make Social Security viable for 75 years and beyond. But we still have this enormous yawning gap out there. If we wanted to just stabilize the debt where it is now, that would require $5 trillion of additional revenue or spending reductions over the next 10 years. And I've given you a chart, a little takeaway on, and you can do your own make it work program. Because this shows what various steps would raise over 10 years. So repealing the tax cuts, I hear on the campaign trail people say, just repeal the tax cuts. Well, that's 1.1 trillion. That doesn't stabilize the debt, right? You need 5 trillion. That's the number if you want to stabilize the debt where it is, and it's already very high historically. You could impose a tax on carbon, starting at $25 a ton. That would raise 1.4 trillion. You could increase corporate tax rate to 25%. That would be 500 billion. Restore the estate tax to 2009 levels. That would raise 330 billion. Remember, we got a $5 trillion bogey here to stabilize the debt. Raise the payroll tax cut, the tax cap, to cover 90% of earnings. It's historical norm. That's at about 195,000 from where it is now. That's 420 billion. Raise the payroll tax rate by 1%, 560 billion. Use chain CPI, which our commission recommended, 340 billion. Raise the retirement age, 100 billion. Return discretionary spending to 2017 levels would save 1.8 trillion. You know, what's happened in Washington is the two sides have gotten into a love hug. You see how they can't reach an agreement on a budget. In fact, the last time anybody took a budget through the whole process, it was me. Since then, they've sort of given up. And so they get in this situation where at the end of the year, right, we all see this drama play out. Are they going to shut down the government? And, you know, they have shut down the government several times. And you ask yourself, gee, isn't there a better way? Well, you know, we used to do it a better way. We actually went through the normal process of coming up with a budget. They've quit coming up with budgets. They may as well end the budget committee because they don't come up with a budget, or at least take it through the process so that you have one. And so what do? At the 11th hour, 5 guys go in a room, and it usually is all guys. I think we'd be better off with some of you women involved. I know some of you are better at math. I don't know what it is. If we see them, they go in and they come back, and what have they done? The Democrats get increase in discretionary spending. The Republicans get the increase in defense spending, and they all walk out arm in arm, self-congratulatory, and say, we reached an agreement. Wow, they reached an agreement. Good for them. They just raised the debt dramatically. So tax cut, same thing. They go in, come back home and tell you, boy, did we do a great thing. We cut your taxes and we raised spending on the things that you like. And don't worry about the debt. Everything is fine. Everything is fine until it's not. And I would tell you, I think when we get, if God forbid, we get to 2026 and they've not done anything about the health care programs and Medicare goes insolvent, and 2034, Social Security goes insolvent, those trips home are going to be a little more awkward. They're going to be a little more difficult. We shouldn't have to wait. The longer we wait, the more draconian the solutions have to be. That is a mathematical certainty. We don't need to wait. We could have this adult conversation. I laid out for you an approach on Social Security. You may not like it, but at least it is a way of getting Social Security back on track for 75 years and beyond. Everybody is better off under that program than waiting for insolvency and taking a 23% cut across the board. The bottom 20% are dramatically better off. Widows and widowers are dramatically better off under the current system. So we do something dramatic about long-term elderly poverty, and we solve the challenges to Social Security insolvency in a way that really is meaningful. And that's not just our saying it. We used the Social Security actual finance models to determine what we were accomplishing. On healthcare, this idea of focusing on that 5%, the chronically ill, who use 50% of the money to better coordinate their care, I think would be a game changer. By the way, not only does it save enormous sums of money, it improves the health care of the people involved. People are much better off if they're not taking prescription drugs they don't need. People are much better off if they don't have to be subjected to multiple tests of the very same kind. I mean, that's just better for people. People are infinitely better if they don't have adverse drug interaction, have to go to the hospital. So there are solutions to these things. I've given you a takeaway. You can think yourself, what of these things make sense? Thank you so much for having me.
Kent, thank you very much. We are going to do the following. If you want to see the Bloomberg Lab, please sign up. We are going to take a 15-minute with a hard stop on the break to get to the next session. And Senator Conrad, thank you for joining us, and we appreciate the fact that we did have one time a successful budget thanks to you. Let's go take a break. You will hear from Mike Drury again today when he introduces Loretta. And at that point in time, they will hear the introduction in Bradenton. Okay, you got deficits and debt. We talked about that. We're going to spend the next hour on payments, and I'll turn this program over to Mike McKee of Bloomberg. Mike?
Thank you very much, David. I would note that the sun has finally come out, and now it's our panel. We don't get to go stand outside. So we'll try to keep this moving so that everybody can get a chance to get outside and enjoy a little bit of the sunshine. When I first saw the panel and what we were going to be talking about, I cringed a little bit because there's so much passion around the idea of Bitcoin and cryptocurrencies and things like that. And then I see that what the title of the panel is real-time payments. And all of these things are different things. And there's a lot of confusion about what exactly we're talking about here. And then once you figure out what you're talking about, what does it mean, not just for the future of currencies and payment systems that's at a 10,000-foot level, but for you in the audience going forward. And I know a lot of people probably have heard of Bitcoin, but don't really know what it is and the things that are like it, and what is a real-time payment system and what does that mean. So what we thought we would do is we would start off by asking the smartest people that we have here on stage to sort of explain the background of this, to run you through a little bit of a primer of what we're talking about and what that may mean going forward. So let me quickly introduce the panel. The biographies are in your booklet, so we don't have to go through all that. But from DataTrek, we have Jessica Rabe and Nick Colas. From ETF Trends, Dave Nadig, and Christopher Whalen from Whalen Global Advisors. We're going to start with Jessica and with Nick, and they're going to give you a little background. Dave will, and then we'll get to the Q&A portion.
Good morning, all. There you go. Okay. So I want to give you a quick overview of a broader framework with which to think about the topics that you're going to hear about today. Because Michael's right, this is a very confusing topic. I personally have covered Bitcoin since 2013, and so I've had a lot of experience thinking about these topics and explaining them, but there's a larger story here that I think is useful and interesting, not just from the perspective of what we're going to talk about today, but investing more generally. And that is defining disruptive innovation. And it's a very much overused buzzword. It was originally discussed by a Harvard professor named Clayton Christensen, who really built the model that we all use to think about disruption and what that means to existing business models. And it has two very specific definitions. This is often lost in the more general discussion because we use disruption way too much as a concept. The process is this: an innovative company comes into a marketplace at the low end, and this is really important. It comes in at the low end of a market with a good enough product that is somehow different, either by design or construction, from the products currently in the market. And what happens is that disruptive company might have a technology, it might have a business process, it might have something different, but it does something different that allows it to be successful at the low end of a marketplace. This is not coming in at the mid or the high end. This is solidly grounded in the cheapest stuff in a given market. Why is that important? Because the incumbent companies that have way more resources than the upstart will cede that market to the low-end player. Because why not? If your profit margins go up when you abandon the low end of a market, that's a good thing. So they cede that ground to the low-end player. But over time, that new entrant actually increases market share by moving up the value chain. The incumbents continue to recede because their profit margins and return on capital increase as they drop those lower end products. Those tend to come through at lower profit margins. But eventually, over time, those incumbents simply either adopt the business model of the upstart or go out of business, and then the process repeats itself. The other disruptive pathway is entirely new markets. Think about it in terms of personal computers in the 80s, smartphones over the last 10 years. If you create a brand new market, that's also disruption. But the important point is the first one. The disruption tends to happen at the low end of the market first and foremost. Critical point. Some examples that I think you're all familiar with. I've listed a few here, but let me go back in time. The original retail disruptor in this country wasn't Amazon. It was the Sears Roebuck catalog, which started in the 1910s and 20s as a mail order version, originally at a lower quality point because you couldn't see the goods you were buying. They made it up by providing for free returns. But the Sears Roebuck catalog was the original disruptor. I have in my collection, I collect oddball things. I have a 1920 Sears Roebuck catalog. It's 800 pages. And it is full of every single thing a rural farmer would need for their business. And that was the original disruption. Amazon really was just the internet version of the Sears Roebuck catalog. There is nothing new under the sun. The Japanese auto industry, I covered the auto industry at First Boston through the 1990s as a senior analyst. The Japanese auto industry started in the 1960s offering cheap, low-end cars that were fuel efficient, and the big three said, you know what, that's okay, we'll give them that market. Over time, though, as we know, the Japanese expanded, classic innovative disruption. New markets now, obviously the iPhone created a new market. Tesla is creating a new market. There was some commentary about whether Tesla is a cheap stock, expensive stock. The answer is no one knows. But what we can say for sure is Tesla has made buying an electric vehicle something cool, something interesting, and something attractive. That's a new market. So that's how disruption happens. Low end, moving up, or entirely new. Now let's talk about Bitcoin. Bitcoin fits this model exactly. Bitcoin was started during the financial crisis. The original fans of Bitcoin were just hard money people that didn't like that central banks were printing a lot of money to save the Western economies. But over time, it developed along classic disruption patterns. Other use cases were buying drugs online because it was a semi-anonymous system. Money laundering. Now, these might not be very attractive markets from a moral standpoint, but they are very robust markets from an economic standpoint. And Bitcoin enabled that disruption. Classic low end coming in an underserved market with a cheap new product that has an advantage, and then it grows from there. Online payments are another example of a global disruptive trend because they're obviously enabled by the platforms that we use every day. Global wireless broadband, smartphones. Transactions are data, and there's two major surveillance ecosystems in the world, the Chinese government surveillance system and the Western capitalist surveillance system. Both rely on data. The Chinese to help control the population. In the West, it's to make money. Existing systems are still expensive, obviously. Transferring money or paying with a debit card will cost you 2%. If you want to send $100 from here to Argentina, that's a 10% charge right now, actually closer to 15. So existing payment systems are definitely ripe for disruption. Markets see the possibilities. Bitcoin's market cap right now is $180 billion. That's bigger than all these businesses, PayPal, Amex, Western Union, Goldman Sachs. The market sees that possibility. And I always try to bring a prop. We all know what this is, right? Does anybody know how many of these things exist in the world? Lots is the correct answer. The precise answer is $1.3 trillion. And that's a whole lot. There's enough $100 bills in the world that every human on the planet could have 1.8 of them. That's how many hundreds there are. That is the one market that Bitcoin is ultimately trying to disrupt. It's very much a substitution, and Bitcoin's market cap is much smaller. Wrapping up, as much as all this sounds awesome, and it is, money is super complicated, and we'll get into that in the panel. There's 130 currencies outstanding in the world. Economic sovereignty is largely defined by being able to control your money in banking, your monetary policy, financial transactions regulations, all very important. Central banks are interested in issuing what's called stable coins or central bank digital currencies because they see a lot of the trends that I've listed here really coming into play. The future of money is more digital. There's many more people still without access to banking services that need them, and so forth. The bottom line, and I'll turn it over to Jessica now, is that the Bank of International Settlements just did a survey. And it showed, as they surveyed all the central banks around the world, that within 36 months, 20% of all the people on the planet will live in a country where their central bank issues a digital currency directly. So this is coming. China is the biggest chunk of that. But this is clearly a trend that's coming, and that's a good setup for what the panel will discuss in terms of what that means and what the potential ramifications are. With that, I'll turn it over to Jessica.
Thank you, Nick. Hello, everyone. I'll lower this a little bit. So as DataCheck's resident millennial, we thought it would be a good idea for me to give my perspective on mobile payments because my generation will decide the future of money for decades to come. Let me just switch this over. There you go. There are a few good reasons for that, which are up there. Number one, as the speaker said earlier, we are the largest generation now in the US, and that's both generally overall, but also in the workforce. And secondly, we view money, though, differently than our boomer parents because we've had two distinct experiences. Number one was living through the financial crisis at a young and formative age. And number two, we have record levels of student debt. So we have to be careful with how we spend. But we're also not the most trustful of established financial institutions. And a unique feature of millennials is we enjoyed a high level of digital literacy growing up from a young age. So we live our lives online through our smartphones every single day. And as a result, we adopt new technologies that are low cost, free, convenient, and tech enabled. So I thought I would just give you my payment diary as a millennial to give you a sense of how much mobile payments dominate my life. There are only two reasons I ever use cash, and that's to tip at the nail or hair salons, because they won't accept anything else. And quite frankly, the haircut itself and the manicure itself, I use a debit card for. So, usually I have to run to the bank before those appointments and hope I have enough cash on hand. But so that's because all my daily transactions, I use a debit card for. Anything online, I use PayPal so I can check out with a few clicks. Venmo, I'll say my paying rent has become a lot easier for me. I used to have to write out a check and mail it. Now through Venmo, which is a sharing payment app, it takes me 2 minutes to send my payment to my landlord, and I have and it makes me feel better that I know she has the money right away. It's quick and easy, and it gives us some peace of mind. Other ways, PayPal, I said, I use it for all online. Venmo also when splitting bills with friends. The last time I wrote a check was probably 9 months ago to an electrician, and I was happy I had one in my desk. I got kind of lucky there. So yeah, pretty much never use cash. Everything Venmo, PayPal, debit card makes it super easy. And so I thought I'd just outline, since we are going to decide the future of money in the U.S., some of the features that I've already shared, I just thought I'd put them up on the board and just give you a few examples. So number one, obviously, we like low cost or even better free. So for the example there is Robinhood, which is a trading app, and it lets you trade stocks without the fees. So quite frankly, we have high fixed monthly costs like rent or our student loans. So if we have anything to be able to invest, obviously, cutting out the fees is very helpful. So that's an app that's very appealing to millennials. Want it to be easy to use. Again, I love PayPal, anything online. If PayPal's the option, that's what I use. It saves me from having to go find my wallet, take my card out, punch in all the numbers, put my card back in my wallet, and put my wallet back in my purse, where I could just check out so simply with a few clicks. We like a social aspect, so this is definitely very much different from our parents that we share more and are much more public. Venmo, not only is it free and convenient to use when we're sharing payments with friends or splitting bills, but it has actually a friends feed, so you can see transactions that our friends do amongst each other in terms of sending or requesting money. So, for example, the other night I went out with a friend and we got sushi. She paid for it to make it easy and then just requested money over Venmo with a little sushi emoji. We love our emojis. And it makes it fun. And then I sent the money that I owed her. It was easy and makes it fun. And then our friends can actually like it or comment it. So basically what the app tried to do is also become sort of like a social network, which again, we're on Instagram all the time. I confess, I'm guilty as well. So it makes it fun. We're already accustomed to social networks, and Venmo is an extension of that. Obviously, we like experiences. We like anything that enables an experience-rich life. Bitcoin, I know it had its fall from grace, but a lot of millennials did make good money on that during its historic rise. And again, we're not as trustful of established financial institutions. So I had friends who never invested in stocks, but we're like, oh, I'm up 50 grand in Bitcoin again. and again, that's a digital and decentralized form of money. So they're more comfortable with it, especially from the technology aspect. We trust it. We grew up with it. We live with it every single day. We're used to it. So, then just lastly, we are a very socially conscious, aware generation. So Stash is another trading app. It lets millennials invest in fractional shares for as low as $5. But something that the app was smart about is that it renames ETFs with easy to understand monikers. So like for the iShares Global Clean Energy ETF, they just renamed it Clean and Green. So it's easy for us to understand. That appeals to our values. Great. So to wrap up, I'll just say, again, because we are the largest U.S. generation now, we will shape consumer preferences for decades to come, and that also includes the way we pay for it. So while cash, is not dead, like people like to say, we do favor tech-enabled, low-cost solutions that make our lives easier. And the best analogy I can give, just like our phones are everything from a computer and a TV to a music player to a communication device all in one, our smartphones are also now morphing into our wallets. Thank you.
All right, now it's Dave Nading's turn.
Yeah, I just have 90 seconds and slides. If we could put those up, are they just right here after those? No. There we go. Great. So, hi, I'm Dave Nading. I just wanted to provide a very brief framework for maybe the rest of the discussion and put up one or two slides on adoption. I tend to think of alt money as all of the things that we're talking about, from Bitcoin to Venmo, central bank digital currencies. I think of them all as just versions of money, but there are three different reasons I think we need money. There's stores of value. By that token, gold would be money as well. There's mediums of exchange, which is, I think, how we mostly are going to talk about money here. And then there's the instrument of policy, right? Central banks try to manage economies by controlling how money works in the system, whether it's printing money, whether it's markets, issuing bonds, lots of different ways that they become instruments of policy. I wanted to just put up a couple of adoption charts just to put some scope here. Right, mobile payments right now in China are 2.5 times the size of GDP. In other words, that money is moving almost exclusively through mobile systems. Cash is effectively non-existent. In the U.S., digital wallet adoption is the fastest growing digital technology ever. It's being adopted faster than Twitter and Facebook were, which is somewhat shocking. And also Venmo is now the single largest consumer finance app anywhere in the world, with Cash App fourth place behind it. I will confess that the only interactions I've ever had with my children, other than the nice ones where we hug each other, are through Venmo. That's basically how all of those discussions happen. And this is actually, in certain countries, even more profound. This is from Finland, which is leading the US and the developed world in a lot of ways when it comes to digital currencies. And this just asks the question, when was the last time you actually got money out of a bank? This is sort of to your point here. That number has now become 17%. Never. 17% of the people of Finland say they have never taken cash out of a bank. And then just last thing, just 4 different kinds of digital currencies, and maybe we could just leave these up. I just think these are useful buckets for people to think about, right? I think of things like PayPal, Venmo, Alipay in China. Those are really cash replacements. Their function is just to make that medium of exchange part work really well. Cryptocurrencies like Bitcoin, I think, can have different use cases, but for the most part, I think they have been a digital asset more so than other things. We can talk about why, but transaction volume is a big one there. Then there's things like Libra, which we should really think about as blockchain settled funds, right? Libra is an idea of creating a currency basket which could then get exchanged using a blockchain. Again, not really a currency, really just a new kind of exchange traded security, which I find interesting given my job. And then last, they're general purpose digital currencies issued by central banks, so-called CBDCs. Rolls off the tongue nicely. None of these really exist in a useful way right now. There have been a few little examples, the Marshall Islands probably being the most developed, where you've actually got a blockchain settled US dollar denominated currency as the primary medium of exchange if you live in the Marshall Islands, because there's now no longer a bank in the Marshall Islands. So they had to do something just for people to sort of barter day to day in their lives. So that's, I think, all I need to do here. With that, we'll hand it over to you guys.
Yeah, Chris doesn't have a PowerPoint, but we'll give him his opening statement here. We talked earlier about how this is baseball territory for spring training. Chris Forth is the cleanup hitter.
Thank you, Michael. Good morning, everyone. It's great to be here again. I'm an investment banker. I work in the bond markets and the credit markets, but I also spend a lot of time with clients trying to discern things in the fintech world. When I think about payments, I always try and separate in my mind the cryptocurrencies, which I view as tending to be mostly speculative instruments, with the payment function. I have friends, for example, who live in Lebanon. Lebanon does not have a government. It does not have a civil society per se. So how do they pay their bills? With Bitcoin. It's that offshore, off-the-grid function of Bitcoin that I think is the most interesting, and it's also the most problematic for countries like the United States, where we're very concerned about money laundering and such things. It's fine to talk about cryptocurrencies as assets, but frankly, they're not, but neither is the dollar. Since we gave up on the gold standard, we have, essentially lost the ability to discern value when it comes to money because there is no underlying value. As I noted in one of my earlier books, in this country 200 years ago, people used foreign currency. They didn't like paper dollars. They used English money and Dutch money, especially metal, because they knew what it was worth. And they also knew that the fluctuations in value could be really quite astounding. After the Civil War, for example, paper dollars had traded down to 20% of face value because of the huge inflation that Lincoln had to use to pay for the war. So today, when I look at payments, it's obviously, I think it's disruptive, sure. I'm going to give you an example of this in a second, but it's really evolution. Technology leads the way. Technology is always going to outstrip existing systems, existing governments, existing perceptions that we all have of payments. And so what you've seen is that institutions like the Fed, banks, really anybody who's involved in the world of payments have been overwhelmed by technological change. You know, first we had PayPal, and the banks kind of looked at PayPal for a while and they couldn't figure it out. But within a few years, all of a sudden, they were adopting the same functionality, which is why the leader today, you find them on just about every bank website. It's part of their payments system. And in fact, most banks today have online payments. It's really funny when you watch me signing books, because there are times when my brain just freezes and I realize that I haven't actually used a pen to write anything in so long that I can't even sign my name. The only time I write checks is for Father Wagner at St. Vincent Ferrer in New York, because I take checks, right? They're not quite up to the electronic payments world yet. Maybe I should talk to him about that. But I'll give you an example of how difficult it is to discern exactly what these new entrants into the market are. Years ago, there was a company called Square, and I had followed Square because the founder was also the founder of Twitter. And so I looked at Square, and I looked again, and I bought some stock in single digits. And I kind of at first realized that this wasn't really a revolutionary company. What they had done was come into a market that was very staid for bank credit card merchant accounts. And the banks would kill you. They would take a long time to set up the account. They wanted compensating balances. And if you did anything wrong, they would hit you with horrible penalties. So the guys from Square come in and they say, no, what is it, 2 3/4%, I think, all in. Here's the free equipment for you. Say you run a food truck or a small restaurant or whatever it is, and all of a sudden you could take credit card payments. And you now find them all over the world. And there's got to be dozens of these now. Clover, a whole bunch of them. The stock traded up to $100. And I looked at myself one day and I said, nah, it's time to get out. So I got out. It has since collapsed by about half. Why? Because ultimately it wasn't a revolutionary concept. It was just that somebody came in and they put an overlay on the old world that was more efficient. They broke the old model of banks when it came to merchant accounts. And they did it really well. They served a new consumer group of small merchants who needed this. And they have actually created market share that didn't exist before. But what is the comp for Square? Is it high tech? No, it's Visa and MasterCard. And I think it's going to grow just like Visa and MasterCard have grown in the past based on volume. But again, it's not revolutionary, it's evolutionary. So final thought, and then we'll have our discussion. You know, we have a lot of things going on in the world of payments today. The Bank Clearinghouse has a real-time payment system that's up and running, and they're very excited about this. And our friends at the Federal Reserve System have decided that they need to compete with them in order to have a backstop, a way of ensuring that payments always move. And there's a lot of controversy about this. On the one hand, I understand our friends at the Fed because they're responsible for making money move. The FedWire and the other systems that are part of that are how the US economy gets paid. In order to be a member of that club, to have a master account at a Federal Reserve Bank, you have to be an insured depository institution. Nobody else is allowed. That's both for security reasons and also, I think, for supervisory reasons. The Fed just, over many decades, evolved this role. When I worked at the Fed in the Stone Age for a guy named Paul Volcker, we had check processing and cash. They don't even bother with checks today. The Fed of New York used to be open 24/7. They were just constantly moving bags of cash and checks around, flying them around the country. This is how we did payments. Today, no. Checks have almost gotten to be irrelevant. But the question is, what is the role of government and what is the role of regulated financial institutions in this payment system? And then what about everybody else? Because everybody else are more efficient. They're going to adopt technology, they're going to move faster, and they're going to actually, I think, provide more benefits to all the different types of consumers that they serve. And then the next group are going to be the banks, who tend to move very slowly because they have to. And then finally, governmental agencies like central banks. Do they all have to be involved? I don't know. We're going to have a discussion about this. But I will tell you that I am filled with some trepidation that our friends at the Fed want to go down this road of actually building their own system instead of setting standards, providing oversight, particularly through the banks that participate in the system. Because having worked in Silicon Valley with a lot of really smart people, the one thing I have learned over many decades is that the first time around, it's screwed up. And the second time around, it's screwed up. And what happens in the technology world is you design, you implement, and then you assess. And you have this feedback loop that goes round and round and round. That's how you get it right, ultimately. And you apply this to anything. It could be designing, 737 Maxes. It could be providing new network architecture, whatever it is. It's always bad the first time around. And when you see a government agency essentially getting into what is a retail private sector function, I worry about that because of the money that's going to be required and also the reputational risk that our friends in the central banking community are going to run as a result if it doesn't come out right. So with that, I will pass the baton.
All right. Excuse me, I want to pick up on something that Chris said, and also it came out a little bit in the other presentations there. We're talking about different things when we talk about the digital currencies and the blockchain settled funds and things like that. That's different from the payment systems that we're talking about. And what's interesting is, Civil War era, they were mentioning the payment system was you got your currency, your bill or your metal, and you went and handed it to somebody. And then the payment system evolved, and they had a brand new way where you could really move money around. You wrote a check and sent it out, and that was a payment system. And now we've moved on to these digital payment systems. But checks were checks, and specie was specie. Now we've got all these different payment systems, and I'll start with Jessica because she's the millennial here who uses all these things on a regular basis. What's the market? How's the market going to evolve? The list that you had of all the different payment systems, are we going to be choosing from a whole lot of them? Is natural competition going to winnow it out? And do the big banks basically come in, backed by the Fed or whatever, and say, this is what we're going to do, put the pressure on merchants and say, this is how it's going to evolve, and we'll end up with the same kind of monopoly going forward?
I think, I'll say from my experience, I use a few different ones. So I'll use PayPal for online payments. I'll use Venmo with friends. But I would say I think there is a lot of growth in this area to evolve. So, for example, I don't use Apple Pay yet, but I could certainly see myself doing that in the future, using it because, like I said, our smartphones become our wallet. So to connect that, be able to just check out easily with a thumbprint or just the NFC technology, I could see that definitely in the future. But that means there's a lot of growth there that my generation hasn't necessarily caught on just yet, but will.
Nick, I'll follow up with you, not because you're old, but you're older. And I know for perhaps this audience, a lot of this seems a little scary. What's my world going to look like going forward? Are we going to be able to operate if you're not digitally savvy, carrying around a smartphone all the time?
Thanks for the starting point. The funny thing about this discussion is if you look at, the Federal Reserve publishes every year how much cash is in the system. And you would think with all the conversation around this topic that cash would be declining, and in fact it is not. At every denomination from 1s through 20s, transactional cash outstanding is growing faster than population growth plus inflation. So the funny thing about this trend is that cash is still growing. It's just not growing as fast as digital payments, but cash outstanding in the system is growing at 2 to 4%. $100 bill balances are growing by 7% because there's such a global demand for $100 bills. So the funny thing about the cash versus electronic story is cash still has growth. It hasn't yet stabilized. People still use cash. So for me, the bottom line is cash is still going to be relevant. The things we're talking about today are really what's going to shape payment systems, technologies, and the society's view of what cash is. But cash, physical cash, still a growth industry.
Well, in the U.S., I think it's important to say that in the U.S. because
In the U.S. and Euro. The
Yeah.
ECB gives monthly balances of cash outstanding. They grow faster than dollar bills.
Right. But if you look into China, right, we've got the exact opposite thing happening. And I think the reason we've seen China jumping very much to the front of the central bank digital currency conversation with their proposal for digital yuan is that they don't have control of their actual currency anymore because frankly, Alipay has become the shadow economy in terms of where money moves in the Chinese economy. And so, yeah, in M-Pesa, it's the same thing in Africa. So I think the interesting question is, from their perspective, going to a central bank digital currency isn't about rescuing cash, it's about reasserting control, right? And certainly in the proposal from China, it's a little concerning. It's really obvious they're going to have the transaction records of every citizen in the country.
Right. I mean, the fascinating thing, and this is a big macro point, there is essentially a two-horse global technology race for the next 20 to 30 years. It is China and it is us, and there is nothing in between. Europe is the regulatory function for the world, but it's China and U.S. technology. China is going down a state surveillance path, which is why the CBDC makes so much sense. The U.S. goes down a capitalist surveillance path where we basically get advertised based on all the data surveillance that Google and Facebook and everybody else does about us. So the interesting thing will be if China's digital currency takes off in 3 years and enables better economic growth, is that one example of how the Chinese surveillance state structure is going to allow for faster growth in China than our approach does here? It's a wonderful microcosm of that much bigger question.
Yeah, but the interesting point you just raised, from my perspective working in the capital markets, there are only three currencies, dollars, euros, and yen. The rest of them are too small. They just can't support large commercial payments. The Chinese, I wrote a piece on China this morning for American Conservative. I don't think we'll ever let their currency become a global means of exchange, because until the Communist Party falls and you see real democracy in China, I just don't think it fits into their model, because everything in China is about political stability. They make ridiculous economic decisions all the time, simply because they think it enforces political stability and control. But let me also say, I think that the banks, because of the vast power they have, and because, remember, banks, as I said before, are a monopoly. They have access, direct access to the payment system. Everybody else is a customer. So even when you're dealing with these independent payments providers like PayPal, eventually they have to go into a bank. All of them, SoFi, I don't care who you're talking about, all of these so-called disruptors, unless they take the time and the trouble, and this is one area where I work, to become a bank, they don't have a hard IP address on the payment system network. In order to do that, you have to be a regulated financial institution. If that changes, then the entire game changes, because the Googles and the Apples and everything else would come in and very quickly supplant the banks. I've always said, as a bank analyst, you want to fix the problem of large, too big to fail banks, get rid of the ownership restrictions in the Federal Reserve Act. And I guarantee you within a year, Citibank, Deutsche, HSBC would all be acquired and broken up. That the only thing that protects them is the ownership restrictions that say this is a special club, we have to regulate it and protect it because of the economic impact.
Do we need to do something like that, I'll throw it out to the whole panel, to enable technology to move forward? Or as I sort of asked earlier, are we just going to see the banks come down and say, this is the way it's going to be done, and you're going to be stuck with whatever we decide?
I'll jump in there. I mean, I think the regulatory issue is the big one, right? And we saw this when Libra was first announced. The whole point of Libra was to try to get out from underneath the banking umbrella, to try to create something that could be a store of value and a medium of exchange that was not run through the Federal Reserve System, right? Yeah. And they immediately got smacked by every regulator who looked at it, and very quickly most of that coalition got cold feet about it.
Well, that's right. But right? You know what's funny? I poked at them a couple of times in some articles I wrote on this. If they had had a little better advice and taken more time in researching this, all you have to do is go and get a charter for a federally insured trust company. It doesn't even have to be a bank. You go to the FDIC and the OCC, you get a trust company license, you get access to the payment system, and then they would be able to meet the concerns about Libra being huge because of all the Facebook users. Where would you put the money if people were using it for payments? And this is a legitimate concern. The way you answer that concern is by joining the club. Because if you don't join the club, then as I said before, you're a customer.
Right. So I think we'll get there. I think somebody will crack this. And I mean, your point, I think, was very well taken, that all of these kinds of innovations take several tilts at the windmill before I mean, nobody talks about MySpace anymore for a reason, right? You got to make a few runs at this. And I think of things like blockchain, like the initial blockchain currencies like Bitcoin, like Libra, in some ways are going to be the MySpace of the thing that is finally locked in. Now, Bitcoin may have enough of a head start on store of value and statelessness that they may stick around. But I think we don't know what the end state is. But regulation, I think, is going to be a big part of it. And whether it's by sort of carefully joining the club or working with the SEC to create a new class of security that's tradable off exchange without the DTC, that kind of thing, it will get there. But it's going to take regulatory work.
Let me follow up on the idea of Bitcoin and some of these others, Ethereum, that are payment systems, but also pseudocurrencies. Even leaving aside what is the value of a Bitcoin, I mean, does anybody know, other than what it is quoted at the moment? My question about these has always been, is there any country in the world you can name that is going to willingly give up its regulatory role and its seigniorage role and allow these currencies to supplant their fiat currency?
I guess the simple answer is no, and it doesn't matter. And that's sort of the point we made about sovereignty is, sovereignty, currency and sovereignty are intertwined for a whole variety of reasons, regulatory, monetary policy, and so forth. Technology, because more than half the world has a smartphone, more than half the world has access to broadband internet, mobile broadband internet, these things will just keep coming up over and over and over again. You've already seeded the ground with everything you need infrastructure-wise to develop these and new currencies. So governments can do all the regulation they want. They can say what they want to say. Bitcoin sprang up literally out of nowhere. Like, to this day, no one knows who even wrote the original code or paper, which kind of shows you how the anonymity aspect of Bitcoin resonates with people. So countries can do what they want, central banks can do what they want, and over the long term, it's largely irrelevant.
But I wonder about that, though, Chris, because as you point out, if you don't have access to the payment system, and governments can cut off access to the payment system.
The payment system is your smartphone. That's it.
It is, but let me give you an example. Physical currency typically have serial numbers. Every note is unique. Securities have been largely digitized. We don't have physical bearer bonds anymore. We have unique identifiers for every single security and every single coupon payment for a bond or a stock. I think eventually the central banks are going to use technology so that every single dollar, for example, is going to have a unique identifier. When they do that, then you will have achieved what Bitcoin was essentially doing with blockchain and say, I can track every single one of these and I know every transaction, every value that has occurred.
But I think we're going to get both, right? I think we're going to end up with both. To your point, I think, yes, there are going to be systems that work outside the fiat currency system, and those are going to have incredible value in the unbanked world, in the shadow economies of the world. Those things will have real value, whether it's Bitcoin or something else. But I think, to your point as well, I also think central banks are going to realize they're going to get in on the game, and governments like the United States or the governments in Europe aren't just going to simply stop taking tax receipts in their local currency and stop paying government workers, right? Ultimately, that's the ultimate driver of the need for a fiat currency is taxes have to get collected and the government pays its bills.
Well, going back to the earlier panels, the only thing that allows Americans to behave like libertines, which is what we are, is that the fact that the rest of the world uses the dollar as a means of exchange. The competition that's now threatened by technology attacks that very directly. In fact, if you really understand the Bitcoin thesis, it is anti-bank. It is anti-central bank. There's nothing funnier to me than Bank of America having lots of blockchain patents because blockchain was meant to get rid of them. They're my bank, by the way. But, It's funny in a sense that whoever it was that posited that thesis for blockchain and Bitcoin, they tapped into a huge pent-up demand that nobody had seen. It just kind of exploded with no marketing, no consultants, nothing. And I always tell people, I say, look, if you want to play with this, play with Bitcoin. At least you can make money. But don't spend any money on blockchain because it's the worst security suite you're ever going to see. It's been hacked so many times that it's not even worth talking about anymore. But at least the concept is there, and I think the concept is very valuable.
Well, that raises the question about security that I want to pose. With all of these different systems, I think Nick is thinking Jessica's going to have something to say about this. There's no system that hasn't been hacked by somebody, and if the incentive is enough, and getting access to your bank account is certainly an incentive for criminals, how do we have confidence in all these systems going forward?
I think that's true. The core payment systems that you see banks using have been kept so clunky and so limited that they're actually very robust. There are times when the banks will get hacked, usually by fraud. This is a huge problem in the mortgage industry today. When we close on your house, we have to verify payment instructions 2 and 3 times. We actually want to talk to the guy who's going to do the close to make sure that somebody's not playing games. But I think the core payment system, and this is why they move so slowly, has been kept deliberately dumb in order to avoid exactly that.
Yeah, but what about the Venmos and the Zells and the other systems when it's on your smartphone? How are we going to know that we're secure?
Yeah, I think why Nick was sort of gave me the mic is, I think for millennials, it's just not as much of a concern for us. We've trusted technology from such a young age and relied on it. And quite frankly, I mean, just look at any millennial's Instagram account. We are not private. Like, my mom does not understand why, if we're on vacation, I'll snap a picture and tag the location and post it on my Instagram story. She's like, why do you want people knowing your personal business? But for us, that's how we grew up. We enjoy it. We enjoy sharing. We're just not as private as our parents were.
But I think there's actually a real issue, and it's less the system gets hacked and all the Venmo balances in the world go to zero. I don't think that's actually as big a risk as some people might make it out to be. The bigger issue is the one-on-one interactions that larger vendors and customers are going to have. I have several friends who built small businesses on the back of PayPal payments, right? And that's their fundamental source of income, hundreds of thousands of dollars running through a PayPal account. One of them got hacked, and they've been in a 3-year dispute now over a $50,000 balance that's just sitting there, and they have no recourse because it's not regulated the way a bank would be, right? You wouldn't be able to drag that out in court for 3 years to try to get a $50,000 balance out of a bank account that was yours. But PayPal is an arbitrated system. It's a contractual system. It lives outside the normal regulatory environment that we think of. Now, it is regulated as a payment transfer processor. There are regulations, but they're not the regulations we all might be used to in thinking about investments in securities.
Even Nick and I, all our payments for our customers are vast majority credit cards and PayPal. PayPal because it's easy, and same with credit
I'm
cards.
guessing you don't leave a giant PayPal balance sitting there.
Yeah.
You sweep that out. Yeah.
Every week.
Yeah, exactly.
Well, what happens when, just to pick a country off the top of my head, Iran hacks into Venmo or one of these systems, and it just doesn't work? And that's where all your transfers are. I mean, how do we function then?
I guess the bottom line is, don't worry about it. No. There are so many things to worry about. Like, you heard 2 hours of worry this morning, and that's all awesome. But you can't make investment or personal decisions based off of it. It's fine to worry, just don't act too much on it.
Well, no, what's happening is that the industry, both the banks and the non-banks, continue to have to stay ahead of the bad guys. And so what you're seeing now is that if you use online payments or anything of that nature, you're going to have double, sometimes triple authentication before you get access to the system. Most of my bank and credit card relationships, even if I do password, they send me a unique ID. Sometimes you have to do a third step If you, interact with the federal government on the website for everything now, there's a 3-step authentication process, and they're going exactly to that point.
Yeah, and it's also, by the way, on like Venmo, for example, it's free to just like instantly take money out of your Venmo account and put it into your bank account. I do instant transfers all the time. I don't leave big balances in my PayPal or Venmo. It's just a mode of transmission.
Let me channel my inner Elizabeth Warren here, and and go back to Chris's initial comments about the Federal Reserve getting involved in the payments, the real-time payment system, and whether that's a good idea for them to be competing with private industry. Why wouldn't, just to play devil's advocate and think of what she would say, why wouldn't we want the government guarantee that the system will work, because there's no guarantee that private industry is going to have our best interests at heart?
Well, look, the clearinghouse, which is a very old institution, represents the largest banks in the country. They are regulated. They are locked down 8 ways to Sunday when it comes to their payments flow between the bank and other banks and the bank and the Fed. So to me, I would much rather see the Fed as the facilitator and the standard setter rather than having them get into the world of tech, because honestly, that's beyond their competency. They do run technology, of course they do. They run a vast technology platform at the Fed. But do we really need to have them competing with private sector entities that we know are more nimble and more efficient? I'll tell you a funny aside. 90% of the mortgages in this country are made by non-banks. And it's not because the banks are bad, they're just horribly inefficient. They buy those mortgages from them and they count them as their own production. And the stats are totally wrong. So in the same way, any other industry you look at, the non-banks are going to be much more efficient.
Well, and there's a huge tech build here too, right? The Fed's not going to build the infrastructure required. Just to put things in scale, the Visa MasterCard system processes peaks at about 90,000 transactions per second, which is the fastest payment system in the world at the moment. The U.S. Stock Exchange system, NBBO, at peak processes about 200 to 300 transactions per second. PayPal, the core blockchain of Bitcoin currently is at 7. That's the high. I think it's peaked at 9 at one point when the mining was absolutely at the highest, but that's come off. Now, there are solutions to that, but the point is if you wanted to make blockchain the trading and settlement activity for every exchange we're going to make, you have to either build another layer on top of it, or you have to reinvent a new protocol, or you have to throw an incredible amount of hardware at it. So the Fed's not going to build that system to replace the 67,000 per second transactions happening in Visa MasterCard.
Yeah, I'd say the one thing, and you hear central bankers talking about this as they discuss CBDCs, is let's just say that you can build them and they can be efficient, but what happens in a financial crisis when depositors at institutions say, you know what, I feel safer with a deposit directly at the Fed, and you get a massive liquidity move out of the banking system into central banks? That's something that even the Chinese central bank is going to have to address, because their financial system is more fragile than ours, but that's the real risk to the system. You can build these fine, and I totally take Chris's point that it's unlikely the Fed could be better than Google at developing these systems, but even assuming they can, what happens during the next financial crisis? You know, we've had recent problems in the stock market and money markets because of repo facilities. That's been sort of the inside baseball discussion for several months. This would be that times 10,000.
But let me give you an example. If you go into the older Federal Reserve banks around the country, they have teller windows.
They're used the New York Fed cafeteria is now in the space where the teller windows used to be.
So people used to go in the front door and transact business directly with the Fed. Over time, they decided that that was a bad idea, and they decided that the banks, who are regulated, were better able to meet that need. And as long as the Fed supported them with cash when they needed cash, it was okay. And now we have this very robust payment system. Do we really need to replicate, and I'm talking about retail payments here, I'm not talking about wholesale. That's fine, that's how you deal with a crisis. But do we really need to have individual banks and or non-banks interacting directly with the Fed? I don't think so.
A little promotion here. Loretta Mester, who's going to be speaking next. the Cleveland Fed building is one of the most beautiful buildings in the world. They have teller windows. You should, if you're in Cleveland, go take a look at her building. It's really beautiful.
Pink marble.
Yeah. Let me finish up with this question here, because it kind of comes back to the way everybody thinks about this, and we've tried to make the case that these are all different things that we're talking about. But how would each of you, and we need to make it quick because David's standing up because we're running out of time, how would each of you tell the audience to think about Bitcoin? And you can use any of the other pseudocurrencies, cryptocurrencies, you could throw them in there as well. But what are they to these people, and how should they think about it?
Again, to us, growing up through the financial crisis, we saw a lot of our parents lose a lot of money from greedy players in the financial system. You can watch any movie on Wall Street, like Wolf of Wall Street. That's the kind of content that we watch and take in, and that's what we lived through and learned. So for millennials, having something that's technology-based, that's digital, we grew up with that. It's been good to us. We trust it. And having a decentralized means of money is actually, that's a feature, not a bug to us.
Two-word answer, it's basically digital gold. It replicates a lot of the scarcity value of gold, some of the store of value, some of the long-term belief. We're all a function of our environments. Technology creates trust, and for 5,000 years, gold created trust. It's basically the same idea.
Yeah, I'd only just add that it's gold with call options, right? It's got a call option on being a transaction system. It's got a call option on being a technology base for other development. It's got a call option on sort of shadow banking. So I think it is all those things. It's a psychological commodity like gold, meaning it's just worth what we decide it's worth, but it's got those embedded call options.
I take a different view. I view Bitcoin as a speculative asset. It's like Beanie Babies or baseball cards. It has a payment function, but the payment function is so inefficient that I think over time I've watched banks acquiring one payment provider after another in the retail space. I think you're going to see the banks roll this up over the next 5 to 7 years.
All right, well, we will leave it there and turn it over to David Kotaka. Thanks to our panel here.
Terrific panel on payments. Michael McKee and the panel, thank you very much. Wonderful panel on payments. We are about to get to the last part of the program today. And I'd like to open the session and then have Michael Drury introduce President Mester, but I would like to open the session with a story. It came to pass that the world would end on Tuesday. The New York Times wrote on the front page, "The world will end on Tuesday." History of the world starts on page A26. The Wall Street Journal wrote on the front page, "World to end on Tuesday, stock market reaction mixed." The Washington Post wrote on the front page, "World to end on Tuesday, women and children hurt most." Donald Trump tweeted, "World to end on Tuesday, Federal Reserve at fault." Michael Drury, would you introduce Loretta?
Well, it's a tough act to follow, but my name is Michael Drury, and I'm a past chairman of the Global Interdependence Center, and I'm here to introduce President Loretta Mester, who is a good friend of GIC all the way back to our time at the Federal Reserve Bank of Philadelphia, where GIC is a tenant, and she was the director of research. But since June 2014, she's been the president of the Cleveland Fed, where she supervises 1,000 people in Cleveland, Cincinnati, and Pittsburgh, doing economic research, supervising banking institutions, and providing payment services to depository institutions. It is my pleasure to introduce Loretta Mester.
Well, thank you for that double introduction. That was very good. Thanks, I really appreciate it. I want to thank you all for inviting me to be a participant at the GIC event and the University of South Florida, Sarasota-Manatee. I really appreciate being here. So, you know, this is Financial Literacy Day, and I wanted to open with a couple of comments on financial literacy. You probably know that the Federal Reserve is very interested in promoting financial literacy. And one of the reasons is because we really believe that the economy performs better if people are equipped with the knowledge to make sound investment and savings decisions. And of course, another reason is, you know, as monetary policy makers, we know that monetary policy is actually more effective if people really understand how it works. So I think those are valid reasons for the Fed to really be interested in promoting financial literacy. I'm proud that I serve on the board of the Council for Economic Education. This organization is a champion of both economic and financial literacy for students from kindergarten through high school. And the CEE recently released its 2020 survey of the states. And that's a biannual survey that looks into the state of K through 12 economic and financial education in the U.S. And I'm pleased to say that the results of the survey show that progress is being made. 21 states now require high school students to take a course in personal finance. That's 4 more than in 2018. And 25 states now require an economics course, which is 3 more than in 2018. So the CE is working to encourage more states to adopt such requirements. And one of the reasons is that there's now research out there about these state requirements. And the research shows that when states have those requirements, it actually leads students to make more informed real-world economic decisions, such as those pertaining to college financing. And so I think that's an important reason and why everyone in this room and at the University of Southern Florida should care about this. I'm also proud that the Cleveland Fed is an active partner with schools across the 4th Federal Reserve District to improve the financial skills of students and members of our community. And I hope that you will visit our beautiful building. It is a lovely building. And we have in the bottom of the building next to where the teller windows actually are, a museum and a learning center. And so, you know, you're welcome to visit that. We have another one in Cincinnati, our Cincinnati building as well. But a lot of the materials that we offer are online on our website, and I would welcome you to look at our website for anyone who doesn't want to leave the warmth of the Florida sun because it's snowing and cold in Cleveland right now. So I want to spend the rest of my time with you focusing on the payment system, the great panel, great lead into this talk that I'm going to be talking about. The Fed does play an important role in helping to ensure that our payment system is efficient and secure and effective. And I recently became chair of the Financial Services Policy Committee, which is the Fed committee that oversees the provision of payment services to depository institutions and the U.S. Treasury by the 12 Federal Reserve banks. So as a follow-up, I thought it would be useful to provide you with an update on some of the Fed's ongoing work to modernize the U.S. payment system, and it was touched on in that panel, and then offer a policymaker's perspective on some payments innovations. And of course, what I say today are my own views. They don't represent the Federal Reserve System or my colleagues on the Federal Open Market Committee. So, given what we've been talking about, I don't think it would surprise anyone when I say that a well-functioning and secure payment system is an essential ingredient for a sound economy. Think about railroads, think about highways, think about bridges. The payment system is similar. It's a critical part of the infrastructure of our country. And everyone in the country and in this room and probably in the world has a stake in a healthy U.S. payment system. Now, according to the 2019 Federal Reserve Payments Study, non-cash payments have been growing by almost 7% per year since 2015. And these include debit and credit card transactions, checks, yes, they still exist, and digital and direct deposit and automatic payment transactions that go through the automated clearinghouse system. In 2018, there were 174 billion non-cash transactions made in the U.S., so that's more than 500 payments for every American. And these transactions totaled over $97 trillion. Now, as a nation's central bank, the Federal Reserve works to promote macroeconomic and financial stability of our $21 trillion economy. And the Fed's oversight and participation in the payment system, I think, is a vital part of that work. So last year, the Board of Governors of the Fed announced that we would be developing a new service called FedNow, which was touched upon in the previous panel. So this is a new interbank payment service, and it will allow people all over the country to make payments securely and in real time at all times of the day and night, including weekends and holidays. Now, we've talked about mobile payments. Those payments made through mobile apps and the internet appear to be instantaneous. I can press my, Apple Pay, it's done, right? But the underlying infrastructure doesn't move the funds immediately from the payer's bank to the payee's bank. Currently, this takes several days. Now, with the FedNow service, part of the infrastructure, you'll be able to send and receive payments securely at any time and anywhere and get access to funds within seconds. And the speed, we view, is going to provide economic benefits, making it easier for individuals and businesses to manage money and to make time-sensitive payments. And this service, along with similar private sector alternatives like the clearinghouse's real-time payment service, may be especially beneficial for those households and businesses that don't have as much funds in reserves, allowing them to avoid late fees when making last-minute payments. And we heard about that earlier today, about how under provisioned people are to actually make unexpected payments. So having quicker access to your money is important for a large segment of the population in the US. Workers who aren't getting regular payroll checks also will be able to get faster access to their wages. Now, I think if you look at the history of US payments, you're going to see the need for the FedNow service. I know there's some skepticism. Over the decades, the evolution of the payments landscape has led to a patchwork of payment vehicles and providers, often lacking interoperability with one another or the ability to combine billing invoice information with a payment. So our payment system in the US is concentrated in the banking system, but it is very complex. Currently, there are several platforms for making payments. There's the Automatic Clearinghouse, or ACH, which was conceived in the late 1960s. It handles smaller value, regular scheduled payments like your paycheck or your utility bills. It uses batch processing of a group of transactions during a predetermined time period. Now, ACH was conceived as a way to eliminate the use of paper checks, but checks are still being used for making some payments. There are also credit and debit card systems. So this complexity makes it harder to foster payments innovations. Indeed, not all parts of the US payment system have kept up with the evolving expectations and demands of consumers and businesses. And this has allowed non-bank providers, which we talked about earlier, including the fintech companies, to enter the payments business, offering consumers and businesses more modern payments methods that clear and settle on the bank-centric traditional payments infrastructure. So the consumers and businesses enjoyed a more user-friendly experience. And while it appears that the payments are moving in real time, the actual clearing and settlement of payment instructions on both sides of these transactions take place through the traditional system. So transactions are settled in periodic batches, processed one or more days later, and available only during regular banking hours. Now, of course, this creates some risk because banks might choose to make the final funds available to the customer before receiving and covering funds from the payer's bank. So this highlights the need for an updated US payment system that's faster from end to end and meets the needs of consumers, businesses, and financial institutions in a safe and efficient way. And to address this need, the Fed engaged in several years of study and consultation with a diverse group of payment system stakeholders. That outreach included financial institutions of all sizes, private sector payments networks, businesses, consumers, the fintech companies, and software vendors. And those stakeholders made clear that they wanted access to enhanced interbank settlement mechanisms 24 hours a day, 7 days a week, 365 days, 7 days a week, 365 days a year. And this was reinforced when the vast majority of respondents to a 2018 Federal Reserve request for comment advocated for the Fed to build a faster payment system. So in response to that demand, the Fed has embarked on building a resilient real-time payment system that will enable the nation's more than 10,000 banks and credit unions of all sizes to use their existing electronic connections to the Fed and their existing Fed settlement accounts to process real-time retail payments for consumers and businesses. So I think this payment system modernization is going to bring the U.S. in line with other countries, which we talked about earlier, that have been developing these faster payment networks. These countries include Australia, the UK, Singapore, India, Mexico, and some European countries. Now, in making that decision, we always, before we make a decision to move forward with a new service, right, we want to make sure that the service meets our established criteria for offering a new payment service. So this is a long-standing criteria that we use to actually make the determination of whether we should be a provider or whether we should leave the private sector to be the provider. So the criteria are, first, that it's a service that other providers alone cannot be expected to provide with reasonable effectiveness, scope, and equity. Second, that there's a clear public benefit. And third, that the Fed will be able to fully recover its costs of providing the service over the long run. Now, I think it is important to note that the Fed will offer FedNow alongside the payment services operated by private sector companies, just as it does today with check, ACH, and the wire transfer services. I think this is going to encourage competition among the operators, and it's going to provide an added layer of resiliency in the event of downtime in any one of the real-time payment systems. Right now, we're working closely with financial institutions and technology firms to prepare for an anticipated launch of the FedNow service in 2023 or 2024. And we haven't actually made an official launch date yet because there's ongoing work to finalize the business requirements and the design features to meet the needs of potential users of the service. And those timelines will be based upon what we learn in that process. So this is a complex project, so we really want to take the time to get it right. Now, the FedNow service is being developed with the aim of having a broad nationwide reach and the ability to work across different systems. So as we say, there are private sector systems already out there. We want to have interoperability among those systems. And when we do the outreach with the industry, they pointed out and emphasized the importance of establishing a real-time payment capability for the nation whereby any payer can reach any payee regardless of which real-time payment system is used by their banks. So interoperability has not always been a given in the US, and no doubt it's going to be a challenge. For example, in the early 70s, there were several regional automated clearinghouse associations, each providing clearing and settlement among and between only their own bank members. In most cases, the ACH associations had an agreement with the regional Federal Reserve banks to help operate the ACH networks. In 1974, the regional ACH associations formed NACHA to facilitate the nationwide clearing of ACH transactions. And by 1978, an interoperator agreement between the Federal Reserve and NACHA was executed to link the local ACHs on a nationwide basis. And in fact, the message exchange protocols that allowed that to happen are still in place today. Interoperability is also a feature of the debit card networks and of wire transfers. And for each of these services, interoperability has evolved over decades and followed different paths to arrive at different models. So today, the Fed, private sector operators, and other stakeholders are exploring options to ensure a broad reach for faster payments. Interoperability as currently achieved in the ACH system is one possible approach. Another approach is dual participation, where some banks choose to join one or more of the payments networks. And that's the prevailing model for high-value urgent payments processed through the wire transfer networks. And then hybrid models are also possible, where service providers are designated as agents in each network and route payments to the receiving bank's network of choice. In that setup, a broad reach is achieved by relying on relatively few service providers, each of which establishes connections to all the payment operators for that payment type, thereby acting as hubs. And that's the kind of interoperability that characterizes today's debit card networks. So the Fed's going to be exploring the various possibilities, working with the private sector stakeholders to arrive at the best solution for ensuring that we develop a faster payment service that is broadly accessible to consumers and businesses alike so that it best serves the public. Now, beyond the development of FedNow, the Fed is actively monitoring and studying new technologies and approaches to payments. And as we discussed, these approaches don't always rely on sovereign currency or a country's central bank to settle payments, or on traditional bank accounts to transact payments. So I thought I'd spend the remainder of my time to talk about digital currencies and some of the policy issues that they raise. So as we discussed, everyone's heard of Bitcoin now. It's an example of a digital currency which was introduced in 2008. It held the promise that it could be serve as a means of faster payments, also as a unit of account and as a store of value. And since Bitcoin's introduction, there have been thousands of other digital currencies created. Now, these currencies present an innovative approach to processing payments in which a bank or central authority is replaced with a distributed group of anonymous people who verify the transaction's accuracy and trustworthiness over the internet. And distributed ledger technology, open source software, a downloadable database of account balances allow that decentralized members of the networks to vote with their computing power to determine whether a transaction is valid or not. Now, since they're cryptographically secured, many adopt the term cryptocurrencies to describe Bitcoin and other similar products. So its market cap has grown to over 100 billion euros, but Bitcoin hasn't seen a wide adoption as a means of payment. And partly it's because of what Chris talked earlier. Its value is very volatile. It's driven by speculation in the currency, so it's less useful as a unit of account. And its settlement time has been too slow to make it a practical tool for mainstream payments. Also, the real cost of operating the system is driven by energy consumption to power these vast webs of computers. They're much higher than those associated with traditional sovereign currency. The distributed nature of the governance system around Bitcoin and similar digital currencies also makes it more difficult to resolve any disputes that may arise or to decide on technical changes that likely would be needed as the platform grows. So in part to address some of those challenges, there's been a proliferation of so-called stablecoins. So these are digital currencies designed to minimize price volatility by pegging their value to the value of a stable asset or basket of assets such as commodities, commercial bank deposits, government securities, or sovereign currencies. This limits the price volatility in the stable coins, making them candidates for payments that require a stable medium of exchange. So this practice of backing a form of money by a stable asset certainly is not new. The gold standard, in which the economic unit of account is based on a fixed quantity of gold, was widely used in the 19th and earliest 20th centuries. A modern example is Kenya's M-Pesa system, established in 2007, which enables transfers of mobile phone account balances backed by deposits held at commercial banks, which in turn hold government securities. Facebook's June 2019 announcement of Libra, a stable coin to be made available to its 2.5 billion users, garnered considerable attention because of its potential to reach a global scale in a short period of time. So these announcements, and I agree with the panel, they really have served as a wake-up call to regulators, standard-setting bodies, and central banks around the world for the need to study the benefits and risk of stable coins. So there are benefits. A global stablecoin has the potential to deliver some benefits by increasing the speed of certain payments and improving competition in and lowering the cost of making cross-border payments, which are all very pricey right now. By enhancing the diversity of the payment system infrastructure, global stablecoins could increase resiliency. And they might be attractive to countries that prefer an alternative to the US dollar or the euro for making international transactions. They could also provide an efficient mechanism for commercial banks to settle the payment leg of a wholesale transaction involving the sale of another digital asset. But against these potential benefits, stablecoins also pose some challenges, including a range of legal, governance, and compliance issues. It's likely that there are conflicts in the legal frameworks of different jurisdictions that a global currency may traverse, and such conflicts would need to be reconciled before adoption. For example, there would need to be clarity about when the finality of the payment is achieved and around the rights and obligations of all parties, including on whom and what the stablecoin holder has a claim. Regulators would need to understand who's responsible for operating different aspects of the system and how international safety and soundness standards, such as the principles for financial market infrastructures, would apply to this type of payment system. In addition, in a recent congressional testimony, Fed Chair Jerome Powell highlighted some of the concerns about compliance with consumer privacy and protection statutes, including the rules around know your customer, anti-money laundering, and consumer data privacy. I know that the millennials we heard don't care about privacy, but a lot of us do. Policymakers also need to assess the potential risk to financial stability if stablecoins gain traction. So while the availability of stablecoins may enhance payment system resiliency, it's also the fact that it could also undermine stability if there's a loss of confidence in a global stablecoin that leads to a run on stablecoin redemptions. Similarly, understanding whether stablecoins would impact the effectiveness of traditional monetary policy tools must also be part of the research agenda. Now, another development under study is digital currency that would be issued by a central bank. This would just be like physical currency issued by central banks today, but in a digital form, and potentially without the anonymity of physical currency. Depending on how these currencies are designed, central banks could support them without actually the need for commercial bank involvement via direct issuance into an end user's wallets, combined with central bank facilitated transfer and redemption services. Now, of the 66 central bank respondents to a 2020 survey conducted by the Bank for International Settlements, 80% are currently or soon will be engaged in digital currency work, mostly related to researching, planning for, or piloting the technology. China, Europe, and Russia, among other jurisdictions, have initiatives underway. Some countries like Sweden cite the declining use of cash as motivating their interest in central bank digital currencies. Now, to the extent that they displace cash, such currencies may help to prevent money laundering and tax evasion. Of course, for the same reason, if they're designed without anonymity, they could be used by a totalitarian regime to control its citizenry. In other jurisdictions like Uruguay, central bank digital currency offers the promise of broadening financial inclusion by being more accessible to underserved segments of the population compared with bank accounts. Now, in another survey, many of the responding central banks expressed interest in central bank digital currency as a way to maintain payment systems that are competitive with costly cash issuance or emerging private sector alternatives like Libra. Others have suggested that central bank digital currency could enhance the transmission of monetary policy, offering a more practical way to implement negative interest rates, which some central banks, including the European Central Bank, the Bank of Japan, and the Swiss National Bank, are currently imposing on reserve deposits to address low inflation and low growth. But just as with private sector digital currencies, there's a range of potential risks and policy issues surrounding central bank digital currency that need to be better understood, and the costs and benefits would have to be evaluated before a central bank would implement a central bank digital currency. In the U.S., a basic question is whether the Federal Reserve has the legal authority to issue such a currency and offer transfer and safekeeping services directly to consumers and businesses. Another is whether the central bank would need to gain access to sensitive consumer and business information in order to issue digital currency, and how privacy could be protected. In addition, the design features necessary to prevent illicit activities would need to be determined. And finally, monetary policy transmission, potential disruption to short-term funding markets, and financial stability issues would all need to be evaluated. Now, the outcome of the cost-benefit analysis is likely to differ across countries. The status of the US dollar as a global reserve currency, the stable demand for US banknotes, and the mature developed nature of the US financial system are all distinguishing factors that would need to be taken into account when considering the benefits versus the costs of central bank digital currency in the US. So central banks around the world, including the Fed, continue to research this potential payments innovation, and we're sharing what we learn with one another and with the public as well. So in conclusion, the payment system is undergoing a period of rapid change. The emergence and widespread adoption of new technology has shaped the public's expectations for faster, more efficient, secure, and broadly accessible payment services. And in the US FedNow, the new real-time payment system that the Fed is engaging in is going to be an integral part of a modernized payment system. Now, as the work on FedNow proceeds, so does the evolution of other payments methods like digital currencies. It's a very dynamic market out there, and so we need to keep up with the dynamism. With each payments innovation, there are some benefits, but everyone comes with some risk and policy implications, and they need to be evaluated. So we're monitoring those developments, we're evaluating potential new payments enhancements, and we're engaging with the private sector stakeholders and fellow central banks as we all work to modernize the payment system. And our work, of course, as always, is on behalf of the public. So thank you for your attention. Very happy to take comments and questions.
I think this is on, yes. First, thank you so much for coming to visit us from Cleveland. And I know the Federal Reserve has rules that we cannot give anyone a gift or a stipend of value greater than $25. I think that's the rule. So we have a bag of Bitcoin. And inside you will find milk chocolate in the Bitcoin. Thank you. That costs $19.99. All right. Two questions from me, and then if we have a minute or two left for the audience. Your bank is the hub of cybersecurity. Most people don't know that. Can you say a word or two about that and what's going on?
Yeah, so the Cleveland Fed, on behalf of the Federal Reserve System, has been designated as the bank that's keeping track of cybersecurity within the banking system. So we actually run a system where we collect incidents and analyze incidents to ensure that financial institutions across the nation have the best practices when it comes to sort of being able to be resilient against attack. And so the Board of Governors of the Federal Reserve System, which is in control of the supervision and regulation of the banking, have deemed the Cleveland Fed as being the bank within our Federal Reserve System to actually collect that data and share that data and analyze the data to help ensure that the U.S. payment system remains robust to attack.
The second question is a little personal.
Okay. That's a scary intro.
Yes, it is. We know each other a long time.
A long time.
From the Philadelphia Fed, from a little school in Philadelphia many years ago. Loretta has a very distinguished career. You now chair this committee in the Federal Reserve. Now, I suspect had we been sitting in your office in the Philly Fed 25 years ago, which we did, or 20, or some number of years, I don't
Yeah.
think we should do that, count them anyhow.
No, let's not.
Let's not.
Yeah. When we were 7.
That's it. For you, career path, what's it like? What would you reflect, not to the students, we're going to talk to
Yeah,
them
we're going to
later,
talk to the students.
to the folks here in this career path for you?
So I'm going to put in a plug for the Fed because we heard sort of, it's an important institution. I think we take, everyone I've met in the Fed has always taken our public service role very, very seriously. We really are working on behalf of the public, and that's our mindset. And, there's differences of opinions about what's the best thing for the Fed to be doing, and there's certainly different policy views around that table. But what I want to assure you is that we are apolitical. We do our analyses, we come together, and we try to reach the best consensus we can on whether it be monetary policy, whether it be payments activities, whether it be supervision and regulation and how to supervise banks. So, I think the career path has been one where you join an institution, you're not quite sure what the institution is about, and you find out that the quality of people around you are people you want to spend even more time with. And that's the Federal Reserve System.
Bravo. We have about 5 minutes, 10 minutes for questions. Anybody want to send a question to the Dean of the Business School?
Thank you, David. Right, so since today's Financial Literacy Day, Loretta, I wondered if you could identify 2 or 3 principles that you might share with our students that you think would be major things to remember as they continue their quest towards financial literacy.
Oh, gosh, that's a broad question. So I would make, one of the things that I worry a little bit about is there's just a proliferation of information out there. So my best advice is to go to reliable sources to get your information, because there's a whole lot of people talking and debating and all that. Just make sure you're going to reliable sources. I think the Council of Economic Education has a lot of materials. The Federal Reserve System has a lot of materials. We take time to try to make sure that our materials are reliable materials. But there's a number of institutions that are working on financial literacy. The FDIC, of course, has a program in financial literacy. So that would be the one thing, is just make sure the information you're getting and basing your judgments are from credible sources, because there's just a whole proliferation of information out there. So that would, I guess, be my major. And you have to constantly learn. Things change, but the basics are, put money aside, they're very basic things that are still true, right? Don't spend everything you take in, put money aside, plan, right? Have goals, financial goals. Those basics, it doesn't matter how electronic you get, or those basics are really what leads you, right, to get a foothold and then continue to grow it. So.
I think we have one here.
First of all, I want to thank the GIC, University of South Florida in Cumberland, for an incredibly interesting presentation today. I don't think I'm the only one who feels that way. And secondly, would it be appropriate for people in the audience who own Bitcoin to put their hands up, and somebody up there give us a percentage roughly?
They all sold their Bitcoin at the peak.
I have some.
Yeah. Let me get around to some questions. Quick question.
That's
it.
Question.
Just thank you very much. Thank you very much, Lenny. Wait, you need a microphone, and I got one over here. Yeah, go. I'm going to help direct traffic. Go ahead.
David, for Ms. Mester, you mentioned the cybersecurity aspect of your bank. I'm interested to find out what are the 1 or 2 most compelling issues that you're facing now, given all that we read in the newspaper about cybersecurity.
So I think it was mentioned earlier is that as much as you are always trying to keep up, right? There's always advances out there. So it's really a matter of making sure that, right, you're able to sort of keep up and have your defenses ready, because it's changing every day. I mean, there's defenses against automatic, like bots coming in, but then you find like, well, actually there are actors there who are mobilizing people, and human trying to infiltrate, and the humans actually are harder to defend against. So there's always a new development out in the market, and being able to keep up with that is always a challenge. I'd say another one, which I think we've made a lot of progress on, is the sharing of information. So, the group in Cleveland, works with other government agencies like the FBI, et cetera. So there's been much more understanding that you need to kind of share information to be able to prevent those kind of infiltrating things from going further. And I'd say the third thing that has become sort of important in all kinds of systems are data integrity issues. So because actors, if you're not careful, right, can get into your system, it takes you a while to detect that. And then the question is, well, what happens, the data that you have that you're storing and that you might be backing up every night, how do you know and verify that it's the right data? So those data integrity issues have become much more, I think, important, not just within the Fed and the banking system, but for other trading platforms, et cetera.
Real quick, we have only a couple more minutes.
Reflecting on your remarks and the remarks of the panel of four that you were sitting in front of, do you think that digital wealth, or do you think it's really a form of wealth, or do you think it is merely a form of transferring and transmitting wealth?
So that's a good question. So I was talking about as a payments means, right? But right now, I mean, you have wealth, you don't have a physical, well, you could have like actual physical assets. Most of us don't, right? We own, our bank account, it's sitting in an account, it's a digital account. Or if you have a Vanguard account or a Cumberland, account, if you're wealthy enough to be with David, right? You'll have an account, like that. So it's not, and there's no bearer bonds anymore, we talked about. Actually, in my office in the Fed, which when I first got there, I opened the closet door. There's a huge safe in my office in the Fed. Nothing in it. Actually, when I got there, it was locked and no one could open it, but we got it open. But I think it was because the president back in the day, this is the original building, actually kept the bonds that banks were pledging as collateral, so it was a historical building. But in some sense, we're storing a lot, right, in non-physical assets now. So, and fiat currency, of course, is backed by the credit, faith and credit in the U.S. government. It's not backed by gold.
The fix is in on this one, and my colleague and a former director of research at the Federal Reserve Bank in Atlanta, and longtime friend of Loretta, Bob Eisenbeis, has a question.
I have 2 points, really, or questions. First of all, in the discussion, not as much attention was paid to par, clearance, and settlement. A lot of these cryptocurrencies may or may not involve par, settlement, and clearance. Do you think the Fed would have an advantage operating such a system because of par, clearance, and settlement? And I think that's the main thing. Secondly, people may not know exactly what's happened to check processing. In addition to cybersecurity, I think you may have still some involvement in checks. Would you help people a little bit about what's happened to
the check
clearing?
system is basically imaging, right? So, when you write a check, and sometimes you still have to because people don't accept Venmo sharing things, so you actually have to write a check, right? Once that gets deposited, right, it's digitized. So the whole system is digital now. Very few actual paper checks transmit through trucks. So that's one thing. So in that sense, it's a form of digitalization that hasn't been there, but nonetheless, not the most efficient methodology of moving payments. And I guess your first thing is, when you think about what's the purview of the central bank, right? Settlement and clearing are clearly, in my mind, and I think most people's mind, a central bank function, right? So in that sense, it should belong to the central bank as being their role.
Before I thank Loretta and USF, thank you very much, and everybody who helped us, I'm supposed to announce that in 3 minutes, the guests who signed up to see the Bloomberg Lab meet at the registration table. And if I didn't get that in before I said thank you very much for coming to Sarasota, I'd never get it in. Loretta Mester.
All right, thank you, guys.
Ladies and gentlemen, March 20th, the Global Interdependence Center. I want to tell you, before everybody leaves the room, we now have an exciting program on energy. It'll include carbon tax, and we have a bipartisan panel. 2 former members of Congress, Margaret Good and Carlos Curbelo, have both agreed and committed to be at the conference. March 20th, Jill Fernito has details, and it's on the Global Interdependence Center website if you want to register. Thank you for coming. I hope you enjoyed the day.